Right, good morning, everyone. Attorney Venora, anything to begin?
Yes, good morning, Chair Gillette, Commissioner Betkowski. We have two of the read-ins to provide this morning, and I'm going to ask that one of them be converted to a late filed exhibit because it's taking a little time.
All right.
I'm going to start with read-in double Q, which was a question posed to the Clean Energy Transformation Panel regarding municipal curbside charging, and Mr. Canavan has the information to provide as the read-in.
Yeah, good morning. Reading QQ was directed at the Clean Energy Transformation Panel from a question by Attorney Marshall on behalf of DEEP. It was with reference to OCC 251 subsection E, where the company had indicated that the company is aware of various curbside charging pilot projects implemented by other utilities, including those in New York City, Los Angeles, Seattle, Melrose, and Quebec. The read-in was, the specific question of the reading was, which of these projects used pole-mounted chargers? And the response from the company is that it's our understanding that each of these projects use the following charger mounting options: New York City, dedicated pedestal; Los Angeles, streetlight pole; Seattle, utility pole; Melrose, utility pole; and Quebec, dedicated pedestal.
Okay.
That concludes the reading.
Thank you.
Thank you. And then Mr. Ortega has read-in double R, which was Ms. Skuris's question on EOE's proposed equity ratio of 46.04%, how that compares to certain credit rating agency metrics. Mr. Ortega, do you have that information to provide?
Yes, I do. So the question is whether the 46.04% equity ratio falls in the A category for credit metrics under the S&P methodology, and the answer is that the S&P doesn't provide guidance on that specific equity ratio. However, Moody's does. Moody's says that anything above the anything in the range 50 to 60 will be an A rating, whereas like anything that falls below 50%, so between the 40 to 49%, will be within the BAA range.
Okay. All right, thank you. And then so that leaves us with three remaining read-ins, double G, double K, and double N. Mm-hmm. And I'm going to request that double K is taking a little bit more time to, and it's going to require a little more explanation. And so I'm requesting that be converted to a late filed exhibit.
Okay. I think we're going to be on late file exhibit 138, and it's discuss how courtesy adjustments are recovered. Is that?
Yeah, the cost recovery treatment for courtesy adjustments. That was my note.
Okay, very good.
Thank you. And so that leaves us with two that we are working on, and we'll provide an update after the lunch break.
Okay, thank you. Does any other party or intervener have an administrative matter before we begin? Attorney Wheel.
Thank you. Just quickly, Madam Chair, I just wanted, just in response to the announcement at the end of yesterday regarding the amount of time left, we had reserved 45 minutes for this panel, and I just wanted to ask leave of the authority, if we end up using less than that, we reserve the right but didn't proactively reserve time for the EOE panel. If we could use whatever time we don't use as to this panel for the EOE panel. So if, for instance, if we use 10 minutes here, if we could use 35 for the EOE panel, would that be acceptable?
That is acceptable. Thank you.
Thank you.
Anybody else? All right, then thank you very much for that. And we are going to reserve continue across. I think we have about 45 minutes left for Ms. Skuris, and then we will move into the Office of Consumer Counsel.
Good morning, panel. Be the Skuris for staff. I would like the company to reference RRU 51, RRU 140, Also, if you reference your rebuttal, Ms. Buckley, of Woolridge's testimony, pages 29 to 31. I'd like to a little bit pick up the pace. I have a bunch of questions for you regarding the proxy company recommendations compared to your proposed 17. Staff will, if you wouldn't mind bringing up the summary exhibit. There is a staff exhibit here that essentially summarizes the differences between your proxy group, which is the proposed 17 OCCs, added companies, and then EOE has some proposed LEAPS companies in his LEAPS group. So I'm going to center around these questions around this exhibit here.
Ms. Harris, could you just give me the page numbers again? You kind of went through that very quickly in terms of what you wanted referenced.
I'm
So
looking at reference RRU 51.
yes,
140, and then your rebuttal for Dr. Woolridge at 29 to 31.
thank you.
And basically, essentially, subject to check, what we have here is kind of put together in one snapshot for the company here, just to move this along a bit faster. The first question, RRU 51 Otter Tail. You discuss it's impacted by plastic segments, but you maintained it in your proxy group. First, explain to me what the problem is with the plastic segment and explain why you want to keep it in your proxy group because it's been recommended to be taken out by Dr. Woolridge.
Sure. Yep. So the proxy group, I think this was actually discussed in RRU 51.
Yeah. What is the problem with the plastic segment? First of all, it's not clear.
There, let me just refresh my memory for one moment. Oh, the plastic segment was not expected to continue. So it's discontinued operations. So it would have been included in the 2021 data, but it because it's discontinued operations, we would have removed it from the analysis.
But you left that company in the proxy group, is that right?
Yes, we would have removed the plastics segment analysis. So we would have looked at the company absent plastics because it was being removed. It's discontinued operations.
How can you look at it separately of the plastic segment for the rest of your analysis?
In comparing the segment data, we would have taken the plastic segment out. So the screening criteria is that 70% of the company's operating income would come from regulated operations. Mm-hmm. But if the plastic segment is no longer operating under Otter Tail, we would have taken that out of the
and that
analysis.
Drops the regulated operations amount?
No, that would make then they would make the screen.
It would make the screen?
Yes, that's correct.
Okay. Do you know if the plastic segment has been done? Like, I recall there's an exhibit you have that shows Otter Tail has in one column 70% and then another number which is significantly less. Do you know if that's been achieved, that the segment has been divested for all intents and purposes?
Yeah, let me just look really quickly. It is my understanding that that's the case, yes.
But your change here is prospective, right? At the time of the analysis of 2021, you indicated that Otter Tail did not make the 70% screen, but you made an adjustment under the assumption that there's going to be a divestiture of this plastic segment and thus raising up the percentage from electric revenue?
Well, we would look, we didn't make an assumption. So the plastic segment was divested. And so, you only have 10K data and business segment data annually, but you do have to look at each of the proxy companies over the course of the year to see that if there have been any changes in those businesses over time. And so that data would be reflected in the price data already for the company. And it would only make sense if they had divested those operations to consider the remainder of the company without those operations.
So without those operations, it makes the threshold. Is that correct?
That's correct.
Okay, so that's the issue here is, do you know when the divestment happened?
I don't think that's here. Hold on.
Okay.
Let's see. I would have to get that for you. I don't have that here.
Okay, I'm interested in that because I'd like to know how this impacts. It seems like it's only a few months here, and either way. So could you give that in a read-in or?
Sure.
Okay.
Yeah.
So read in, please, for the date that the Otter Tail divestment of the plastic segment went through.
Okay, Attorney Venora, I can't recall for a TT or a TT. Thank you.
Otter Tail. That's almost ironic, Otter Tail and TT. Okay. If we move on now, the other issue here, there's some debate here with Dr. Woolridge. He includes some other companies. Specifically, if we look at my exhibit here, we got CMS Energy, Con Ed, Dominion, and Southern. Subject to check, these companies were included in the PURA authorized proxy group for 160604. Your rationale here is that they violated the 70% threshold for regulated electric operations. I'd like to clarify if that violation of the 70% threshold was either the way the PURA has done it in the past with 70% gross revenues from electric services, or in one of your responses, you clarify that your threshold is a greater than 70% of utility operating income derived from electric services. So it's violation of your threshold with the UIO, utility operating income.
That's correct.
Okay, and had we used the PURA approach where it's just gross revenues, do you know if CMS, Con Ed, Dominion, and Southern would have made the cut?
I don't. I can certainly take a look at that for you.
Okay, but I don't know. I think that might be is that a read-in type thing or?
Yeah, I can probably do that as a read-in. Sure. So it's CMS, Dominion,
Con Ed,
Con
and
Ed.
Southern.
And Southern. Yep.
So we're going to clarify if they would pass the gross revenues 70% threshold.
Okay, let's read in UU.
Another question here in your responses, you indicated rationale for excluding Dominion and Pinnacle West was that there was a transformative transaction. Can you clarify what you mean by transformative transaction?
Yeah, so can you refer to specifically what you're reading?
Should be in one of these interrogatories here, the 51 and 140. You specifically use the term transformative transaction. And that's specific to Dominion, Pinnacle West. Maybe you could look at your rebuttal to Dr. Woolridge, could be in there.
Sure. I just like the context.
I'm thinking it's probably in your testimony rebuttal, because I don't see it in the intro.
I don't see it in the interrogatories either, nor do I see it actually. I don't see that word transformative in my rebuttal testimony either. So
Well, clearly you identified that.
I just don't have that. I don't see that in the testimony when I search for it. I can speak to why Pinnacle West was excluded from the proxy group if you'd like. I just
Okay.
don't. I can't
Go ahead.
necessarily say that it was that I used the word transformative. Pinnacle West was excluded from the proxy group because of the change in the company's the significant change in the company's stock price that occurred after its APS subsidiaries rate determination, where the company lost about 24% of its value and was downgraded, and its growth rate went from about 4% to 0.01%. So based on that information, we determined that that was a company that was not of comparable risk to the subject company.
Okay, maybe that's what. So what was APS?
Arizona Public Service.
Okay, and what happened there? They were.
So Arizona Public Service, they in their rate proceeding, they received an 8.7% ROE and a 40% equity ratio, and their stock price lost about 25% of its value over the course of the two decisions that were issued. There's sort of an interim decision and a final decision.
And what happened after? Did they were stock downgraded. Price come back? I mean, how are they doing now?
Well, they were downgraded. They were unable to issue. In their letter to shareholders, they indicated that they would not issue equity. They would not further dilute. They had difficulty accessing the capital markets. And their growth rates, as I indicated, went from about 3% to 0.1%. And so the risks associated with that company did not seem comparable to the subject company here.
Okay, but the question here was it a period of time that this occurred? How is the company doing?
Yeah, it was within the analytical period that we were using the data.
Okay.
So
that could be a month of time, but what's happened now? Have they come back? Is their stock price back up? Is it growth rate estimates? How are they doing?
The growth rate estimates are still less than 1%.
Okay, so that was okay, go ahead.
Yeah, so the stock price has still remained low. It has been very volatile and low, and the growth rate estimates, I'm just looking for my most recent model. The growth rate estimates for Pinnacle West are still less than 1%.
Okay.
0.1%.
Okay, the other one that was Dominion. Was there anything special happening to Dominion that was reason to exclude from the proxy group?
I believe Dominion had a transaction, and that's why Dominion was.
So maybe that's
where
the transformative transaction.
Yes, I think Dominion was involved in a transaction at the time.
And you mean by that merger?
A divestiture, I believe, of assets.
They were selling portion of their assets?
Yes. I believe that's the case.
And did that happen?
Is it concluded?
Yeah.
Is that what you're asking?
Did it? Was it achieved? The divestiture.
Yeah, I'd have to look and see. I can read that in as well.
Okay. Read in Dominion transaction.
Okay, so that's VV Dominion transaction closing date.
Yeah, I believe it was the Questar pipeline at the time that they were divesting. My quick look here looks as though they have completed divestiture of Questar.
Generally, when we, in terms of the proxy group, exclusion of a particular company has occurred if they're merging. How come you're extending that to just spinning off some assets? Was this Crestar a huge portion of Dominion?
It was a significant operation, part of their business, so it certainly would affect the stock price of the company and the growth rate of the company in the analytical period. So I actually have always used, and I think most people that I have seen provide testimony on cost of capital have considered all forms of transformative transactions, not just mergers,
Okay.
because they do affect the stock price and the growth rate for the DCF.
Great. Let's move on. Now, we've gone over most of these companies, that are in addition, that Dr. Woolridge has recommended in addition to your 17. There's a few here that there were nothing brought up. Those would be the WEC Energy, the Hawaii Electric, McGee Energy, MCGEE. Is there any particular reason why WEC, Hawaii, and McGee have been excluded? Because from years of doing this, they've always been in the proxy groups.
Yeah, so MGE, I believe, I'll have to confirm this, but I believe at the time of the analysis, they did not have more than one analyst covering them.
That's not a criteria, though, how many analysts cover. It's only if they're followed by value line. That's the criteria. And to the best of my knowledge, McGee is followed by value line. Is that correct?
I believe they may not be. Let me just check. In response to the first part of your question, though, that is one of the screening criteria that I have relied on historically, is that they be covered by more than one analyst, not just value line.
Okay, so that's a difference. That's one of your screening criterias.
That would be correct. But I can check the value line as well.
Maybe that'd be easier to just, read it in later.
Sure,
than
that's fine.
Hold us up here.
Sure.
So maybe we'll have another read-in on McGee, PGS, SWW, McGee. Coverage, I guess if it's followed by value line.
So I actually have them pulled up right here.
Oh, okay.
So they are covered by value line, but they do not have any growth rate estimates from value line any longer. So difficult to use.
Is that just in one time period? I mean, we could look at it ourselves.
This is the December report.
But
I haven't.
No future growth there.
There are no growth rates from value line.
Okay. What about Hawaii and the other one, the WEC? I know Hawaii is followed by value line and WEC. Hawaii is a company that's typically included.
Yeah, I think this is discussed in the testimony. I think the segment data related to their banking industry makes them not particularly comparable.
That's Hawaii?
Yes, they have a large banking portion of their business.
So what you're saying, it got screened out because it didn't meet the 70% criteria?
I'm just pulling that back up, but yes, I believe so. This is addressed in the rebuttal.
And if that's the case, if you'd clarify if it's the gross revenues or the refinement that you make for using the utility operating income revenue threshold, the
Yeah.
70%.
All of my screening would be based on operating income,
Okay.
not based on revenue. So. I think it's probably best to read it in for you so that you can keep going.
All right,
I'll keep trying to find it here as we're going through.
Okay, so I guess we're gonna just identify that as Hawaii electric. Why screened out?
Okay, I think that's WW.
And the last one here that we have was the WEC energy.
WEC doesn't make the threshold, the operating income threshold for electric operations.
Your UIO, but would it have made the 70% gross revenues threshold?
From electric operations? No.
Yeah, okay. Gross revenues, right?
Revenues, yes.
Okay, we've covered quite a few of these. There's another proxy group proposed by EOE, and it's called the LEAPS proxy group. This proxy group also has companies here: Centerpoint Energy, Exelon Corp, First Energy, and PPL Group, and Sempra. Southern, we've already covered. Could you clarify why you would exclude those companies from a proxy group?
I would have to go back through all the screening criteria to see what they missed. So they were screened out based on some of the screening criteria that I developed here in my testimony. I would have to go back and look at each of the screening criteria to look at how they were screened out. I don't believe that EOE actually used that proxy group to do their DCF analysis.
Okay.
That proxy group was used in their, as I recall, in their COE term structure analysis, not their DCF and CAPM, as I understand. Could be mistaken. Pretty sure that's true.
Yeah, I think they had two separate proxy groups.
Right.
But
they did have two separate proxy groups, but they were not they did not run all of their DCF analysis on the second proxy group, I don't believe.
Okay. Since they're out there as potential companies to include in the proxy group, would you be willing to run through the criteria of screening?
Sure.
And let us know what items the Centerpoint, Exelon, First Energy, PPL, and Sempra would violate. And with regards to the revenue criteria, provide a further refinement between whether it's the 70% utility operating income threshold that's violated or the 70% gross revenues that is violated. So I guess we're looking for a late file on these companies here.
All right, so I'll make late file exhibit 139, discuss why the company excluded the EOE proposed LEAPS companies from its proxy group.
Okay, if we move forward now, regarding RRU 141, and it's also cross-referenced to your pre-filed testimony Exhibit 5, which is your betas. Is it correct that you're the only witness in this process that has provided Bloomberg betas?
I think that's correct.
Okay.
Yes, I've also provided value line betas. So I've
Yes,
looked at
but-
Bloomberg and value line in
Right,
my
that's
analysis.
correct. The others have done the value line as well, if that's correct, right? Like,
Dr. Woolridge has, I don't believe that Mr. Rothschild is using the value line betas. I believe he's using some forward-looking options betas.
correct. Given the exhibit that we had up here, I would request if the company, for completion of the record, give us, if willing, the Bloomberg betas for the 8 additional OCC companies and those of the Rothschild LEAPS.
Sure.
If we could
So-
call that complete, RRU 141.
Let me just make sure I have the list of companies. So you want Bloomberg betas for CMS, Dominion.
We can give you that exhibit.
Yep, that'd be fine.
That'd be easier.
Yep,
Okay,
that'd be perfect.
we can Move forward.
Sure.
Looking at EIX, Edison International, it has a bond rating of Baa3 from Moody's and BBB from S&P, subject to check. Is the Baa3 the lowest investment grade that there is?
Yep.
Okay, so 1 second here. So late file exhibit 140 was referred to RRU 140, or what was the?
It's the, I would I identify it as complete RRU 141 Bloomberg betas for the staff identified companies that have been excluded from Proxy Group.
I would just like to clarify, it's those specific companies that are on that list. Is that
Yeah,
correct?
yes.
Okay.
Sure.
The broader group is 35 companies in total. So I just wanted to
Correct.
make sure
Yeah,
we're
just
focused
the
on
ones
these
that I've
companies.
flagged as having been
Yep.
potentially excluded erroneously. So that's the 8 from Woolridge, and then there's the other 5 from Rothschild. I mean, you don't have to duplicate Southern since that's in both of theirs. Okay. Regarding
I'm
your-
sorry, Miss, just for clarity, could I just read into the record what those companies are? Just
Please.
because we don't have that, I just want to make sure there's no confusion at all. So it would be Con Ed, Dominion, WEC Energy, Hawaiian Electric, Pinnacle, CMS Energy, MGEE Energy, Southern Company, Centerpoint Energy, Exelon, First Energy, PPL Corp, and Sempra. So is that,
Thank you.
okay, thank you.
Okay, I'd like her to move on now to her rebuttal for Rothschild at page 90 and rebuttal Woolridge, page 56, bond yield plus analysis, and also cross-reference 172 and 174.
I'm gonna ask you to give me that one more time.
I'm sorry. Okay, Rothschild rebuttal at 90, Woolridge rebuttal at 56, RRU 172, RRU 174. And this is a very simple question. You don't even need to look them up. The question here is, you've contended that authorized returns for electric utilities are relevant to investors and a gauge rather than a gauge of commission behavior as postulated by Dr. Woolridge. My question to you is, if allowed returns are the relevant factors, would we also need to assume that commission's rate-making decisions proxy investors' actual required return? If not, why not?
I think the Pinnacle West example is precisely why not, actually. That commission authorized an ROE of 8.7, and the investment community, they were downgraded. The stock price lost 24% of its value. So I would say that that's a perfect example of why not.
Okay, that's one version, one example
Right.
happened, but is that typically the case that investors follow commission decisions
Yes.
closely?
I believe
That's
that
your
that's true.
convention?
Yes, I believe that that is true. I believe that Moody's, the credit rating agencies, pay attention
They're
to.
not investors, though. They're credit rating agencies. We're talking about buyers, sellers of stocks.
Yes, I was going to finish my sentence. The complete thought was that the credit rating agencies are watching, as well as the equity analysts and investors. So very often, Bank of America will report on rate cases within less than 24 hours of a rate case determination being made. There will be some discussion from Bank of America following the rate case outcomes. So they are followed very closely.
Okay. Further follow-up on RRU 174.
Mrs. Curry, I have something to add. I'm in charge of investor relations at Avangrid, so I deal with investors on daily basis, and I deal with the sell side, that are the analysts that write about the companies, and I can assure that they look very closely at the jurisdictions where companies operate, and very closely at all the rate cases that are ongoing, and they quote challenging jurisdictions or jurisdictions that have that is harder to achieve certain ROEs or equity debt ratios.
Regarding the bond yield plus analysis, was there a particular particular commission that has fully adopted your approach that you're aware of?
Bond yield plus risk premium.
Yes, not just considered, but actually utilized in their analysis.
Yeah, so that's a hard thing to say, because I would say that many commissions in their orders will say we've considered all of the analyses, and then they will make their determination from there. So I don't know that any one commission, I've testified in probably 36 or 37 states at this point, and I don't think that there's a commission that specifically identifies a given model that they've used necessarily. They typically will outline all the models that have been considered, and that would be amongst the models considered in several states.
Okay, let's move on to another topic, CAPM, reference response to RRU 83, Part D. Your estimates for your market risk premium have been identified as ranging from 9.14 to 9.78, subject to check. Looking at your other parties here that have provided testimony, Dr. Woolridge, for example, has recommended a market risk premium of 6%, and Mr. Rothschild is in the range of 3.1 to 5.1%, subject to check. It appears to me that your market risk premium is about 58% higher as the opposing estimate from the next best estimate, that's Dr. Woolridge of the 6%. And how I get that is the average of your range of approximately 9.5 less 6% turns out to be about 58% higher. Can you explain to me why investors based on your approach require essentially 58% more return as measured by the equity risk premium as compared to similar approaches taken by other analysts?
Well, I think the approaches are all completely different. So the methodologies that are being relied upon, Dr. Woolridge is using a historical market risk premium, and I'm using a projected market risk premium. So the methodology that I use has been relied upon by the FERC. That approach is part of the FERC's current calculation for estimating the cost of equity. The market return in that calculation, which is about 12.5% right now, is in line with the historical average market return from the historical data that Dr. Woolridge relies on. So if you looked at the data from 1929 to 2021 and looked at the annual returns, you would get to about 12.34%. We're at about 12.5 in our forward-looking estimate. So I think that's pretty. It's a pretty good benchmark for what the return is, and then the market risk premium is by the Kroll and Duff and Phelps prior to Kroll, by their own analysis, the market risk premium is the difference between the market return and the risk-free rate. So.
And I have a final question, because I think some of the other questions I have here were covered earlier when you were testifying with Mr. Ortega. Let's move on to the eCAPM, which is RRU 86 and 167. There's discussion also with Woolridge rebuttal at page 53. Now, you've testified here several times with the Connecticut PURA. You are aware that in the past we have rejected the eCAPM approach. Is that correct?
You have maybe not relied on it. I don't necessarily know that it has been rejected. Those are different, in my opinion.
Okay, but you are aware that it's not been utilized in the analysis?
Yes.
Now, in this response, you did provide another article. I believe this article, Chetrin and Coggins, has been previously submitted with your testimony in other dockets, including 2012-30, which was the Connecticut water case, which you were a witness in. Is that correct?
Which response are you on? I'm sorry.
It should be RRU 170, where you provide Chetrin, I'll spell it CHRETIEN, and Coggins, COGGINS. And it must be an attachment. Maybe it's an attachment to 169. Are you familiar with the article?
I am familiar with the article. It would just be, I just feel like it would be helpful to be able to follow the data responses that you're referring to as you're speaking.
There could be an attachment, James, to RRU 169, number 4. Is that it? Yeah, he found it. James found it. Thank you. So that would be 169, RRU 169, attachment 4 is the provision of the article.
Okay. Thank you.
Now, this study, you indicated it reviews, based on my read of your response, that it reviews CAPM, but looking at the study itself, it's actually reviewing Fama French model as opposed to CAPM. Isn't that correct?
I don't believe so. Attachment 4?
Yeah, he's got it up here.
Right, I'm looking at it as well. It's reviewing the CAPM.
I believe it was reviewing the Fama French model with the multi, here, it says it right there in the abstract, Fama French.
Well, I'm on page 3, and we're talking about the equity risk premium method and the CAPM. So I'm in the text of the document, and it is referring, it's referencing the CAPM.
Okay, but the Fama French is an extension of it, isn't that correct?
Yeah, yes.
Okay, so you're saying that that doesn't discuss,
It does discuss Fama French. I think what you asked me was whether this was referring to the CAPM or not, and I said it is referring to the CAPM. So unless I misunderstood your question.
and it goes one step further and discusses the Fama French model. And my question is how is the eCAPM related to this article? Because it doesn't appear to be coming in here at all.
Yeah, so this article is basically demonstrating what some of the imperfections are with the CAPM, and that the eCAPM is essentially a correction for those imperfections in the CAPM.
And besides, I did not see that word in this article at all, eCAPM. So I need you to point me out how the eCAPM is a correction to the CAPM based upon this article. Okay, I'll just let the article speak for itself. But last question here, you referenced 2 decisions in New York and Montana, and your response indicated that the eCAPM was incorporated in those states' analysis.
Yes, that's correct.
To what extent was it incorporated? Was it considered, as you would say, that, you know, we got this filed and we took a look at it, or did the Montana and New York Commission staff actually work out an eCAPM analysis and throw it into their model?
It's actually relied upon. So in New York, it's basically one of the methodologies that they use is the eCAPM, and it's weighted with a DCF. So there's a formula that's used in New York. It's a DCF model, and the eCAPM essentially that are weighted 33% CAPM and the remainder DCF.
So it's incorporated within that 33%,
It is the 33%. Yes.
not the regular CAPM?
Right.
Okay. Okay, and what about your other state?
Yes, I believe that was also included in their final models that they considered in establishing their recommendation.
But you don't know the extent?
I'd have to go back and just review that. I'm happy to do that for you.
Okay, we're gonna move to the OCC in 5 minutes here.
I think this is the end of what I have, so
Okay.
we want to do a read in that.
Sure.
Wait a late file, and investigate that.
Okay, so it'd be read in XX, which was,
eCAPM in Montana.
okay.
And that's it. I think my other cross we kind of covered
Okay,
previously, so I think I'm all done.
all right, very good. So we've had a number of read-ins here, but I'm gonna take those up after lunch. Okay.
Yeah.
I think those all sound like ones we can knock off pretty quickly after lunch.
Okay, very good. We'll check back in then. Thank you. In that case, I'd call up the OCC, please.
Madam Chair, we've actually determined we don't have cross for this panel, so we'd just like to shift our 45 minutes to the EOE panel.
Very good. Attorney Wright.
No.
Very good, thank you. That brings us to the EOE. Okay. I think we got to the EOE quicker than they were expecting, so we can, we'll just briefly recess here. Nope, that was clear.
We just have 2 seconds to bring our.
Of course, we're briefly recessing.
It's coming in the right.
Okay.
Chair Gillette, we actually have an administrative question. Just a clarification. I think Ms. Skouras is still in the room, but on late file 139, the company was asked to provide some information on the Bloomberg betas, and I think we just want clarification on the dates or the date range. That would be that staff would like us to address in that late file.
Sure, and just to clarify, I have that as a late file exhibit 140.
Oh,
Um,
I'm sorry.
but Ms. Skouras, do you have a date range for the Bloomberg betas, please? Does RRU 141 perhaps provide a date range? I can pull it up.
I guess I have to ask you to clarify, what can you provide? I mean, it would be better if you could provide the bloom. Are you able to go back in time and give us the corresponding date and that you filed your pre-trial testimony, or do you have to do it?
Yes, I mean, I could give it to you for any time period. I could give you the time, just to know which one you wanted. So my direct, my rebuttal.
Oh, okay.
I just don't know what
this
time
is-
period you want.
Maybe you can clarify, in your record, do you have your SIR rebuttal? Did you update those Bloomberg betas?
Yes,
And do you have them in an exhibit there?
I have. Yes, I would have the Bloomberg betas for my proxy group.
Yep,
As a-
17. It could, would you mind to give me the exhibit in your SIR rebuttal? And maybe we could just match the time period there.
I think it's rebuttal, right?
Yes, I'm sorry, you're right.
So-
Rebuttal to the, other witnesses.
Right, so that would be November 30th, 2022. So I could give you to you as of that date, if that's
Okay,
helpful.
I wasn't sure if we were able to go back. So-
Yes, I can.
And what was the exhibit again, if you don't mind?
Oh, I'm sorry, this is rebuttal, exhibit UI-AEB-rebuttal-4A.
And you have them all listed there. I just don't have it.
Yes,
Okay. So yeah, let's try to match the time period since you're able to go back in time. Sometimes you cannot.
yep, that's fine.
Okay.
All right, thank you.
Thank you.
All right, very good. So let's move to cross-examination of this panel by EOE, please.
Morning. I'm Brittany Wyman for EOE staff, joined by my colleague Kim White and our expert Aaron Rothschild, who will be conducting the majority of the questions. Yep. I have a quick question. Oh, go ahead.
At the beginning of Ms. Buckley, when she was sworn in yesterday in her direct, they said, UI said it was filing an updated supplement. Have you filed that yet?
We have not. That was the chart that we pulled up during.
Right, yeah, I'm sorry, I just understood. So do you haven't filed?
We have
it?
not filed it yet.
Okay, thank you.
Okay, good morning. It's good to meet you in person. Would you agree that one of the primary purposes of our testimonies is to educate? In other words, to help people who do not spend as much time as we do calculating the cost of equity to understand the concepts and definitions? And also to make this topic as fascinating as possible.
Absolutely.
So it's important to be clear about definitions, correct?
I would guess, yes. I think it's important to be clear about what you mean.
Do you find that people who do not spend all their time working on rate of return testimonies can get frustrated because it's difficult to understand the difference between return on equity, ROE, and cost of equity, COE?
I can't opine on what other people understand or don't understand, Mr. Rothschild.
So you have not experienced that type of confusion by talking to people in terms of understanding the difference between those two definitions?
I don't believe so.
You haven't?
I think oftentimes they're used interchangeably by people in this environment.
You have seen them used interchangeably.
I have, yes.
Do you find that can be problematic?
I have not found that to be problematic in the context of a regulatory proceeding, no.
again, to this idea of fascinating, would you agree that when people do not understand those differences, this topic can quickly become less interesting or challenging?
I'm sorry, I haven't found that to be a concern.
I understand. The ROE, or return on equity, is really an accounting return, correct?
It is.
Your ROE recommendation is equal to your determination of UI's cost of equity in this proceeding, is that correct?
Say that again?
Your ROE recommendation in this proceeding is equal to your determination of UI's cost of equity. Is that correct?
It's the investor required return, yes.
Because you state on page 25 of your direct testimony that, quote, the cost of equity is a market-based concept. Is that correct?
I would imagine that's true, yes. I don't actually see that on my testimony on page 25, but I would agree with that statement.
You also state on page 9 of your direct testimony, I hope I have the page right, quote, to the extent the company has the opportunity to earn its market-based cost of equity, neither customers nor shareholders are disadvantaged. Is that correct?
I don't actually see that on page 9 of my testimony either, but don't disagree with the statement.
But after Pura determines an authorized ROE, it will be applied to rate base, or the original cost less depreciation of UI's investments. In other words, the authorized ROE becomes an accounting return. Is that correct?
It does get applied to rate base, yes, that's correct.
On page 5 of your direct testimony, it provides the following quote from Hope. Do I have the page number correct?
No.
Let me see, maybe I'm referring to the rebuttal.
I believe what's happening is it's maybe the document page, not necessarily the page numbered or the reverse. I think there's just an issue between which way that's going, and I'm trying to figure out that difference for you. But if you can continue your questioning, I will get back.
Are you referring to the PDF numbers, page numbers versus the paper page number? Is that what you're saying?
I think that might be the issue.
Okay.
Yeah, I'm going to bring up, yeah. 1 second. on page 5 now of my direct testimony, if you have that in front of you, or you can agree subject to check of this quote from my testimony. It says the return to the equity owner should be commensurate with returns on investments in other enterprises having corresponding risks. Is this an accurate quote from the Hope decision?
I didn't prepare it, this piece of testimony, so.
I guess we could ask you, Mr. Rothschild, is that an accurate quote? Because, I mean, you took that decision and put it into your testimony. I don't think she has the decision committed to memory, so.
Is that her understanding of the Hope decision?
This is not a quote that I use from the Hope decision, so I don't know. This is not, I didn't prepare this testimony, that's all I can say. And this isn't, I don't have all of the language of Hope in my mind.
Do you recommend that Pura follow this standard?
Which standard?
Represented in this quote?
I'm so sorry. I broke something. Can is Robin can I don't know what I touched. I didn't think I touched anything. No, I broke the volume somehow.
Oh, I'm still working.
Okay. Okay, Attorney Venora, can you try your mic for me?
Testing. No, I don't think this is working. Wait, maybe it is.
Okay, the live stream here. Okay, I'm very sorry. Go ahead, Mr. That doesn't sound right.
Okay. On page 8 of your direct testimony, it states that the end result, as opposed to the methodology employed, is a controlling factor in arriving at just and reasonable rates. Is that correct?
That's correct. It's from Hope.
And on page 38, lines 15 to 20 of your direct testimony, it states, how does the current expected market return of 12.94% compare to observed historical market returns? And the answer is, given the range of annual equity returns that have been observed over the past 96 years, as shown in figure 9 below, a current expected return of 12.94% is not unreasonable. In 50 of the past 95 years, i.e. in approximately 52% of all observations, the realized total equity return was at least 12.94% or greater. Is that correct?
Yes, it is. And I believe Ms. Skirk and I had a conversation this morning that talked about the average of those returns over time being about 12.34. So again, the average over that historical time period being 12.34%. So in that same range.
Say, quote, not unreasonable. Do you mean that you have determined that investors collectively are expecting a return on the market price of equity of 12.94%?
I'm saying it's a reasonable estimate of the return in the market, given the historical observation and the historical average return of 1234.
Source of this historical data is from the Ibbotson 2022 yearbook. Is that correct?
Yes, that's correct.
When you say that, quote,
2021, I think.
2021 yearbook?
I think it's a 2021 yearbook.
Okay, my main question is the source, and it's the Ibbotson book, either 2021. Okay.
Yes.
When you say that, quote, a current expected return of 12.94% is not unreasonable, did you consider the Ibbotson yearbook's assessment of reasonable forward-looking equity return expectations?
I would have to look at the page that you're referring to in the Ibbotson book. The Ibbotson book has a variety of expected data and methodologies identified in it. So you'd have to show me the page you're referring to, I think. I don't have all of Ibbotson here.
Okay. Did you I think you answered the question, but did you consider that this book's forward-looking earnings model that calculates the long-term supply of U.S. equity returns to be 9.81%?
Mr. Rothschild, could you point us to the page where you're getting that reference?
Yes. Supply that after. I don't want to take people's time to find it.
I think the question is, did you consider this? And so ultimately that is Mr. Rothschild's question. So that's a yes or no answer. Without looking at the exact page of the book, did you consider this information that he's referring to?
Well,
I'm going to object to that question. How you're asking us to, or asking the witness to accept at face value what you're representing as the page information, and we just all we're asking is provide the page reference. That's all. Which is fine, but I'm going to take a step back. Did you consider that portion of the Ibbotson yearbook? Whether or not the information Mr. Rothschild's saying it is correct? Respectfully, Attorney White, which portion? That's what we're just trying to understand. Which portion is being referenced?
Just a few minutes ago, you stated that you used Ibbotson yearbook to come up with your information. You used it, based portion of your testimony on that yearbook. Is that correct?
I relied on the data from the Ibbotson.
And does the data that's in the Ibbotson yearbook include expected returns and the forward-looking earnings model?
I would have to see that. The Ibbotson data, as I answered previously, the Ibbotson book includes a variety of calculations, but I don't have the entire Ibbotson book committed to memory. I think it would be appropriate to show me the page.
Thank you.
Do you use blue chip interest rate forecasts in your calculations?
Yes, I do.
Do you know what companies or organizations provide these forecasts?
Yes, it's a consensus estimate of up to 50 organizations, including investment banks. So I think JP Morgan, Wells Fargo, I could pull up one of their reports and read them all back to you, but several market participants.
Thank you. Have you considered the equity return expectations of these organizations?
In what context?
For example, you mentioned JP Morgan is one on that list, correct?
Yes.
And you have seen in my direct testimony on page 15, table 4.
What page? I'm sorry.
Page 15, table 4.
Yes.
Do you see where it says that JP Morgan Chase has a long-term equity return expectation of 7.9%?
I do see that in your testimony, yes. That is your representation, yes.
Assessing the reasonableness of your end result, the 10.2%, your 10.22% ROE recommendation, should Pura consider JP Morgan's interest rate forecast but not consider their published equity return expectations?
I don't think I've said that they shouldn't consider them. I can't say that this particular long-term return, it's unclear to me from this table what that actually represents. So I think that's where I would leave that.
As discussed above, you used data from the Ibbotson yearbook, you said 2021. Should Pura consider the historical data published by Ibbotson and not consider its 9% equity return expectations? And this is also shown in table 4 on page 15 of my direct testimony.
Mr. Rothschild, just to be clear, so the 9% you just referenced, is that from the Ibbotson, somewhere from Ibbotson, that you were unable to provide us the page reference? Is that where that comes? We just don't know where that comes from.
No, that's
There's a lot in that question that I think
Sure.
you're asking her to take.
This is
So-
provided from Duff and Phelps, and their new name is Kroll, which is the same company that supplies or publishes the source that Ms. Bulker used, which is the Ibbotson yearbook. And the source for that is provided in my direct testimony. It's in table 4, footnote 1. It's the Kroll Cost of Capital Resource Center.
I'm sorry, what's your question?
I'll repeat that. Should Pura consider the historical data published by Ibbotson or Kroll and not consider its 9% equity return expectations?
Well, I guess I would have to say I'm not certain of this. I can't testify that this is what this 9% return expectation is. You're asking me to testify, Mr. Rothschild, to your work, which is a circumstance I think I've testified in 36 or 37 states. I've never been asked to testify to somebody else's analysis before. So I'm struggling with testifying to your work product.
I'm asking in general if Pura should consider Kroll's long-term equity return expectations or not. Should they consider their historical data and not their forward-looking data?
I think the Pura can consider both pieces of information should they choose. I think the Pura's responsibility is to provide all of the information that they're given in this proceeding the weight that they feel it should deserve.
Should Pura consider the equity return expectations of major banks and pension funds to evaluate the end result of our COE models?
If the Pura would like to provide weight to that information, they can.
We're asking as an expert in this matter, would that be something you would suggest or not?
I guess the struggle here is, what is the that? There's no foundation here, or like we're being presented with Mr. Rothschild's encapsulation of that. But I think if there's specific, bank information or specific source information that you want to, present and ask questions on, that's fine. I think the struggle is we're being asked to take at face value with what Mr. Rothschild's put into his testimony. I think if there's the source information, that's fine. But that's the struggle.
I don't think we're looking at specific numbers anymore. We're looking at concepts at this point. Conceptually, do you think this is something that should be considered?
Okay, so Attorney Benora, are you objecting to the expert opining, to the company's witness opining on the concepts?
No, I guess I'm just, let's let the questioning go. I think this is trying to get some clarity on what the concepts are. I think it's coming out a little bit unclear, at least to me, and maybe to our witness. So maybe if we can just have a little more specificity around the concepts that she's being asked to opine on.
Okay.
I think that's, so maybe if they restate their question, we can keep it going.
Okay. Let's proceed and ask that you restate its question, please.
My question is, should PURA consider in general the equity return expectations of major banks and pension funds?
The equity return expectations for what?
For the overall market, for equity returns. For large cap stocks, medium cap stocks, small cap stocks, any of those that are widely published, should they be considered by PURA?
In setting the ROE for
UI.
For UI. They can.
In Exhibit UI-AEB 7 of your direct testimony,
It's your resume. No, wait. I apologize. No, it's not. That was my confusing. Please ignore me. I apologize.
What are we referencing? I'm sorry.
UI-AEB-7.
Yes.
It shows that you use value line long-term growth rates to estimate the S&P 500 required market return of 12.94%. Is that correct?
Yes, it is.
Have you discussed with Value Line the appropriateness of using their growth rate forecasts in the model you used in this exhibit?
No, much same as I haven't discussed with Value Line the use of their growth rates in the DCF model. This is actually an approach that has been relied upon by the FERC and is a accepted portion of their calculation of the cost of equity.
Your resume attached to PFT Exhibit UI-AEB-1A. That's your resume.
It is.
States that you testified in front of the North Dakota Public Service Commission on behalf of Montana Dakota Utilities regarding ROE. Is that correct?
Can you say that again?
It says in your resume that you testified in front of the North Dakota Public Service Commission on behalf of Montana Dakota Utilities regarding ROE.
Yes.
Do you recall in Montana, your Montana Dakota direct testimony, the case number PU-20-379 filed on January 15th, 2021, that you determined that a 13.95% expected return for the overall market is not unreasonable based on forecasts from S&P Global? Would you agree subject to check?
Yeah, I don't have that testimony in front of me. Here. I don't have that testimony in front of me. Do you have it to share with me?
We do have it. Attorney Venora, what is the best way? It's currently in my laptop. Or what we can do, potentially subject to check if you are all right with it, is do this as a late file exhibit, and we can provide that to you during the lunch break, and then the rest of the answer can just come as a late file exhibit.
Sure. This is a piece of, this is Ms. Bulkley's testimony from that proceeding.
I do not believe it's yours, right?
What do you think?
It'll be both.
It has a portion of Ms. Bulkley's and Mr. Rothschild's testimony.
Okay, I'm not sure that I want to admit testimony from another jurisdiction as a late file exhibit. Is there, if we need to show it to support cross, can we get it up on the screen? Do we have a?
We can. It's not currently on our, but we can quickly add that.
Just
We're just going to move on to the next.
Okay.
In this Montana Dakota case, did you Okay.
Yeah.
You stated in your direct testimony, is it correct that recently authorized ROEs may not reflect the current required return?
I have a cite in my testimony.
Excuse me?
Can I have a citation in my testimony? Yes.
Okay.
If we may, just for the time, would you agree with that statement as you sit here now that
I'd
market
just like to
conditions?
see my testimony where we're referring to, as we.
No, we understand.
Process.
Regardless of what you said in your testimony, he's sitting here today. Would you agree with the statement that recently authorized ROEs may not reflect the current required return if market conditions change?
Recently authorized ROEs, I just want to understand your question. Recently authorized ROEs may not reflect if
market conditions change, would recently authorized ROEs reflect the required return?
They may not.
Okay. Is COE a market-based concept?
Yes.
COE models. Would you agree that COE models are like thermostats that can measure these changes in market conditions?
I'm not sure that, I don't understand the reference to thermostats. I'm sorry.
With a thermostat measuring the change in temperature, if we have a thermostat that during the summer was high and then we changed in the winter, we would expect the thermostat to represent the change in temperature. If a thermostat didn't change when the temperature changed, would you consider that to be a problem for a thermostat or not?
I set my thermostat to the same temperature all year, Mr. Rothschild.
A thermostat, not in a home, but measuring the temperature outside.
This is outside my expertise, I believe.
I believe what we're trying to get at is, would the COE models also likely or similarly show those changes in market conditions? So as the markets change, so would a COE model?
The model itself doesn't change, no.
The output of the information of a COE model would change based upon market conditions.
The results will change based on the inputs included in the model, yes.
Have market conditions changed between the time you filed your testimony in RE11 on May 20th, 2021? In this case?
Yes.
Would you agree, subject to check, that the results of your constant growth DCF, the median results, were 8.99% to 9.85% in RE11?
I don't have that information in front of me.
Would you agree to subject to check that information is correct?
Seems like a pretty low number. So I would want to verify that.
In this case, your DCF, the median results of your DCF results were 8.38% to 9.94%. Is that case? Is that correct?
The median results?
8.38% to 9.94%.
It's the average of the medians, yes.
The average of the medians.
That's the average for 30, 90, and 180 days. That's correct.
Would you agree, as subject to check, that the results of your CAPM were 10.47% to 10.61% in RE11?
That may well be the case. I don't know.
And in this case, your CAPM results were 10.34% to 10.51%?
No. 10.34 to
10.51%?
No, on exhibit UI AEB 2, CAPM results would have been from 10.50% to 11.76%, depending on which betas you were relying on.
Page 72, lines 14 to 17 of your direct testimony. You state, because the share prices of utilities are inversely correlated with interest rates, the utility sector is expected to underperform the market during this period. Therefore, estimates of the ROE using current market data are likely to understate the ROE required to allow utilities to remain competitive and have access to the capital. Is that correct?
Yeah.
Are the share prices of utilities always inversely correlated with interest rates?
I think always is a strong word, but generally speaking, they have been. The chart that I presented yesterday demonstrated very much that they were inversely related.
Have interest rates increased since you filed your testimony in RE11 on May 20th, 2021, with market data used from, I believe in some cases it was July 1st, and in others it was March 31st.
Of what?
RE11, your direct testimony filed on May 20th, 2021. Have interest rates increased since then?
Yes, they have.
Has your proxy group underperformed the overall market since you filed that testimony?
I haven't done any analysis from the 2011 case to now in the preparation of this analysis.
2021.
The RE11 case.
Sure.
However, what I demonstrated yesterday in the chart that we put up on the screen is that the proxy group, my proxy group, has underperformed the market since interest rates have increased. If you were to look at data from July through the most recent data at the end of February. That's the chart that we put up yesterday.
Since that has not yet been filed, is there a way that, or may we ask questions about that in a late file exhibit hearing? About that particular chart?
Yeah, yes. I mean, I think any supplements to the record, any late file exhibits are the subject of late file exhibit hearing.
Thank you. I apologize, just 1 minute.
We have no more questions.
That's it? All right. Thank you.
Thank you.
Any questions? I believe we have completed cross for this panel. I do not have any questions. Attorney Venora, do you need a moment to consider a redirect?
Yes, if we could take 5 minutes and we'll caucus and come back with any redirect.
Okay,
Thank you.
thank you.
Sorry. We're dedicated. So.
I have a question. Does anyone else allowed to ask questions?
30 seconds.
Just a reference. But I called yesterday, and they said I could show up and ask questions. Yeah.
I can offer the evidentiary.
They're not answering the right questions. They're not asking the right questions. It's embarrassing.
Would you like me to request?
I mean, she's asking about, he asked a question about the drop, the stock price. It's 24% drop. And she never answered when that occurred. Do you know when it occurred?
Mr. Buren, do you email me?
Yes, I did. All right, let me get my. I saw that. Yeah, we were just talking about that. Who wasn't it? We just talked to him on Tuesday. Poker face. But we were talking about Everlong and all that stuff. And we said, or, you know, here's like a little, here's how you call their customer service. No one, so maybe got a little tell that he was for the long term, you know. But yeah, that was good. Yeah. I know.
What's you gonna do, run for mayor of Philly? What? That was a great article.
Yeah.
Thank you for that.
Oh,
Yeah.
It was an article.
We're still kicking around.
Yeah. Go around.
I was just telling, you know, we talked about the CAPM, I said, look, I remember back when the commission considered the CAPM something like foreign language, right? Wouldn't touch it.
There's a good article on Tony, right?
Yeah. It was a great article.
Yeah. When the stuff with the camp and stuff, that's nice, you know?
I know he's donating this, and a lot of stuff that's family foundation is sponsoring stuff, because one of the years they had. Oh, yeah, I mean, his family sponsored the fireworks for one thing, they sponsored some other stuff. Yeah. I like it. I said, oh, I gotta bring this to Jack. I was like, oh,
He was in
oh my. Newington Life. He got the Connecticut Parks and Rec Volunteer of the Year for the state. The whole state, yeah. What do you put? In our town, he sponsors this family foundation. Like 1 year they sponsored the fireworks or something like that. He sponsors some other stuff. He bought like the summer camp, parks and rec camp they have, you know, for kids. He's a volunteer and he sponsors different stuff for them and whatnot. So it was nice. 2 or 3 page article on it. Front page picture. It was nice. Like, yeah, library, yeah.
Obviously,
I always see him at the events, you know, because he's volunteering and stuff. I like them. You the business. Generous, you know. Which is not walking the street where I was him now at nighttime. Used to be what? 5 houses from. Yeah, it's nice. I like it.
Oh, yeah. We can find it. I think he's gonna fancy it. We've been anonymous this whole time. A man sitting at the end of the table. Yeah, I know. Yeah. That you guys came. It's like we brought Greg for low income, the one low income. That was great. Who's here? Yeah. We actually asked after. Check that out. You guys have. Try to get him sprung.
Probably everybody's here.
Okay, Attorney Venora,
We have no redirect.
thank you. All right, and I thank this panel for your testimony, and you're excused. We are going to transition into our next panel. So I'll call up the OCC's panel witness, Dr. Woolridge and Attorney Venora. I don't know how far I'm gonna get into your cross, but we'll start probably
Yes, that's.
of the OCC panel.
Yes, that's fine. Attorney Hum will be doing the cross, and we'll just change seats and commence.
All right, very good. Thank you, Attorney Hum.
Hi, Ian. How are you doing? Tough keeping up with you. Yeah. You okay? Yes. Good to see you.
Okay, Attorney Wheel, and when your witness is ready, if you can introduce them so I can swear them in, please.
Yes, this is Dr. Randall Woolridge, the OCC's witness on this panel.
Thank you. Dr. Woolridge, if you could raise your right hand. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury.
I do.
Thank you. Attorney Wheel.
Thank you. Dr. Woolridge, can you just say your name for the record?
My name is the initial J, Randall Woolridge, and that's spelled Woolridge.
Thank you. And did you file direct testimony and rebuttal testimony in this proceeding?
I did.
And did you also sponsor some interrogatory responses in this proceeding?
Yes, I did.
Do you have any corrections to any of those materials at this time?
There are two typos I picked up in my testimony. They are at page 7, line 10. In the parentheses, the 11% should be 9.78%.
And that's page 7, line 10 of your direct testimony?
Yes.
Okay.
The other one was page 26, line 6. And the 21.24 should be 21.63.
Thank you. Just a couple more questions, Dr. Woolridge. Since the time you filed your testimony, have there been any market changes that impact your ultimate analysis?
Well, yeah, since I filed my testimony, obviously at the time I filed it, the 30-year treasury was 3.6%. Today it is 3.9%. So my CAPM estimates would be higher, generally higher by about 10 to 20 basis points. But at the same time, for the DCF analysis, the dividend yields have dropped about 20 basis points as well. The growth rates are pretty much the same. They change a lot this time of year, but the averages and the medians are pretty close to where they've been. So, my DCF numbers are a little lower, my CAPM numbers a little higher. So I'd still be about 9%.
Thank you. And last question, page 21 of your testimony shows interest rates and allowed ROEs. Do you have any more data to add to that study that's been updated since that was filed?
Oh, yeah, I would just like to add 2022 on this, to this. If you add another column, 2022, because when I completed my testimony, the 2022 numbers weren't complete. The average daily treasury yield in 2022 was 3.11%. The average electric ROE was 9.54%. And the average gas ROE was 9.55%. So generally, if you look at the analysis and the discussion that goes with this table, in 2022, the average daily treasury yield went up 105 basis points, while the average authorized electric ROE went up 16 basis points. So I was just kind of completing that table and bringing in 2022. Now, the average electric distribution ROE was 9.11% last year.
Thank you. And with that, Madam Chair, the witness is available for cross-examination.
Very good, thank you. We'll begin with cross by the company, please.
Yes, and thank you, Madam Chair. And good morning, Dr. Woolridge.
Good morning.
Nice to see you again.
Good to see you again. It was a querying case, right?
It was, correct.
Yes, good.
As you know, my name is Robert Hum, and I represent the United Illuminating Company, and I'll ask you some questions this morning.
Okay.
So let's start with your surrebuttal testimony at pages 9 through 10. And specifically, if we can go to the top of page 10 first.
Yes.
And there you state on line 1, I did not use historical growth in determining my DCF growth rate estimate, correct?
That's correct.
And that statement is supported by a quote from your direct testimony, which we can see now back on page 9. There's a block quote from lines 14 through 26.
Yes.
And in that quote on page 9, you state that you gave, quote, primary weight to the projected EPS growth rate of Wall Street analysts, correct?
Yes.
And this quote also states that, quote, the overall range for the projected growth rate indicators, ignoring historical growth, is 4.0% to 5.6%, correct?
Yes.
And in your analysis, Dr. Woolridge, by weighing EPS growth rates more than the other projected rates, you ended up narrowing that range to 5.25% to 5.50%, correct?
Yes.
And the data that you relied on to get to these ranges is in your exhibit JRW 5 at page 5, correct?
Yes. Correct.
And if we can please pull that up, or as you're referring to it yourself, Dr. Woolridge, but if you can look at panel A in JRW 5, page 5.
Yes.
And panel A is your electric proxy group, correct?
Yes.
The column labeled mean on the far right,
Yes.
that column itself has a mean of 5.3% and a
Yes.
median of 5.6%, correct?
Yes.
And that's consistent with the 5.25 to 5.50% range that you use in your SIR rebuttal for the Wall Street analyst growth rates, correct?
Yes.
Now please turn to page 4 of Exhibit JRW-5.
Yes. Yes.
And panel A here for your electric proxy group shows the earnings per share, dividend per share, and book value per share in the columns that's underneath the value line projected growth, correct?
Yes.
And to confirm, these are the EPS, DPS, and BVPS growth rates offered by value line, correct?
Yes.
And the medians here are 4.0 to 5.5, correct?
Yes. No, in panel A?
In panel A.
The medians are 4.0 to 6.0 with an average of 5.2.
Okay, and thank you for that clarification. And that is what I'm referring to. Thank you.
Okay, yeah, that's what I thought. Mhm.
Now, the next section to the right of the projected growth is the sustainable growth from value line, correct? And the median of the sustainable growth rate was 4.0%, as you can see from that last column, correct?
Yes.
And the projected BVPS growth rates of 4.4 and 4.0% fall outside of your ultimate range of 5.25% and 5.5%, correct?
What was that? I don't understand that question.
Sure. So I'm actually now, and I should have clarified this question, Dr. Woolridge, and thank you for pointing that out. So now going back to the value line projected growth, focusing on the, I'm going to withdraw that question.
Okay.
Sorry about that. So now sticking with Exhibit JRW-5, please turn to page 1.
Yes.
This page for the panel A electric proxy group indicates that your DCF analysis is based on a growth rate of 5.38%, correct?
That's right.
And that's the midpoint of that range of 5.25% and 5.0% that we talked about a moment ago, correct?
That's correct.
And the summary of growth rate indicators is provided in Exhibit JRW-5 at page 6, correct?
Yes.
And the first line in this table is entitled Historic Value Line Growth in EPS, DPS, and BVPS, correct?
That's right.
And there, the underlying estimates simply reflect the historical performance for the proxy companies, correct?
Yeah, I don't mean, and I say in my testimony, 95% of the data, at least, that investors get is historic, whether it's in the 10K, it's probably more than that, more like 99%. So, if investors wouldn't be provided this data if it wasn't worth looking at. But I think it provides a good baseline of what the growth rate has been for these companies. And you look at the long-term growth rate of electric companies, 4 to 5%, about 5% has been about right.
Okay, and here the historical estimate is 4.8%, correct?
Yes.
And that's below your estimated growth rate, correct?
That's correct.
When analysts are developing forecast estimates for the EPS, DPS, and BVPS, do they take into account historical performance, which I think you just touched on a moment ago?
But obviously, why would investors be given it if it's worthless, right? The reason investors get reams of historic data is because investing services believe that it's worthwhile. Companies, United Lumen, provides years and years of historic data. Why do they do that? That's for investors. So, I'm not saying, and I agree, analysts consider it, but investors get it, and they also look at it too.
And the estimates for the historic growth in JRW-5 at page 6, those are provided by value line, correct?
Yes, that's correct.
And for each proxy company, the estimate of the EPS, DPS, and BVPS is provided by a single value line analyst, correct?
Yes, it is.
So it's not considered a consensus estimate, correct?
No, I agree with that. There's one analyst who covers, most of the utilities and they move around, but, obviously they use the value line model, whatever that is. And, so it's a reputable source. And so I mean, Ms. Balke and I both use it. I think most utility rate cases, you'll see value line data.
Now, if we could please turn to your direct testimony at page 50.
Yes.
And specifically at lines 5 through 6 of that direct testimony,
Yeah.
you refer to a study that found, quote, value lines forecasts of earnings per share and profit margins were strikingly over-optimistic, correct?
That's correct.
Is there any reason to believe that the EPS would be more over-optimistic than the DPS or BVPS?
Yes.
And why is that?
Value line uses a different approach than everybody else. Okay, they use a 3-year historic period to a projected 3-year period. Okay, and what happens is that number can be really distorted with earnings because earnings go up and down. Okay, dividends and book value per share don't go up and down. So what happens is the EPS numbers can really be distorted because they have a bad earnings year, say, and suddenly the base is lower. So you'll see usually the projections for EPS are above dividends and book value. It's because of the way they do it. The 3-year historic to the 5-year, you tend to have ups and downs in earnings. Dividends, especially for utilities, they increase the dividend every year. The book value per share tends to go up. So you don't have the volatility in dividends and book value that you do in earnings.
Now, sticking with your direct testimony and turning to page 53. And on lines 1 through 4, you indicate that you gave, quote, primary weight to the projected EPS growth rate of Wall Street analysts, correct?
That's correct.
And now referring to page 75 of your direct testimony.
Yes.
Here, I'm going to withdraw this as well, Dr. Woolridge. Do you agree that a component of equity return is compensation for the risk of the investment?
Yes.
And do you agree that if the investor has a choice of 2 equity investments that offer equal returns, is it reasonable to expect that they would choose the investment with a lower risk profile?
Well, the assumption of all of economics and finance is investors are risk averse. They require a higher return to take on more risk. I mean, that's kind of where all economic and finance models are based. But yeah, the presumption is risk aversion. You require a higher return to take on higher risk. And I assume that I think that's the point you're making, correct?
Well, would you also agree that generally it is not logical for an investor to purchase the stock of a utility company if the return on the utility stock is lower than the yield on the utility bond?
Generally, I would say that's true.
And are you aware that PURA has adopted a screening practice to exclude implausibly low ROEs when calculating the DCF?
I know, I totally disagree with it because it violates basic economic principles. And when, the reason in these proceedings and if you look at any Wall Street valuation report, you put together a proxy group. Why do you put together a proxy group? Because all these things are measured with error. And that's why we put together a proxy group. Hopefully you're going to average out the errors by using a group of companies and not just one company to estimate a ROE for a utility. And what happens when you start slapping off the bottom ones, you're distorting the results because we need all the results because we're trying to average out all the errors we have in the dividend yields and the growth rates and that sort of thing. So everything's measured with error. It's called a basic economic principle called errors in the variable. And that's what you're doing by eliminating some and not eliminating others. So you're taking away from this data set you're using to estimate an ROE.
You agree, though, that Pura has adopted that screening practice, correct?
Pura has adopted many different things, and it kind of changes over time. I remember we had the generic ROE case many years ago, and I remember there were a lot of recommendations. I've never seen any of them used, so I don't know what Pura's rules are at this point.
And would you agree with me, subject to check, that Pura adopted that screening practice in the Connecticut water case in docket 20-12-30, specifically at page 37 of the order?
Okay, I will agree with that subject check, and I'll say it violates basic economic principles about how you use proxy groups to estimate returns and other factors.
Okay. Now turning to another subject, you relied on several sources for the calculation of the market risk premium used in your CAPM, correct?
I did. Lots of, I 30 some, I have the primary ones I use, but I look at 30 some studies and that sort of thing. I mean, there's historic studies, there are ex ante model studies, there are surveys, and I look at all of them, and I specify my testimony. There's certain ones I focus on more. Kroll or Duff and Phelps that was discussed when Ms. Balky was being cross-examined. And I give primary weight to that and several others. KPMG updates their market risk premium every quarter, that sort of thing. So these are, I mean, you Google market risk premium, these are the things that come up. These are what investors would see.
Now turning to page 6 of exhibit JRW6.
Yes.
And in the top line there, one of the sources that you list is Ibbotson from 2016, which uses the historical stock returns dash bond returns for its methodology, correct?
Yes.
And this study arrives at a mean historical risk premium of 6%, correct?
Yes, that's using the arithmetic mean, bond return, and stock return versus the geometric mean, which I've discussed. I don't know if we've really discussed it here, but the geometric mean is a return like the SEC requires mutual funds to use. So the geometric mean return is what investors are supposed to hear.
Now, have you reviewed Ms. Bulkley's testimony, exhibits, discovery responses, and work papers submitted in this case?
Yes.
If you can please turn to Ms. Bulkley's testimony at page 39.
I'm afraid this book doesn't have Ms. Bulky's. I have her rebuttal testimony in this book. I have it in my book out back, but I don't have it here in this book.
Sure. And Dr. Woolridge, since you've reviewed her testimony, maybe I'll ask you a question and if you need, okay, you have it there.
Oh yeah, I got it. Okay.
Great. All right. Thank you.
Yes.
So on page 39 of Ms. Bulkley's direct testimony, do you see figure 9 at the top of the page?
I do.
And is it your understanding that this is historical data providing the total annual returns from 1926 through technically 2021?
Yes.
Do you have any reason to believe that the data provided in Ms. Bulkley's figure 9 does not represent the Ibbotson market return data?
I agree. It represents a historic market return data. Now, I'm not sure how she measured. Oh, okay. This is the raw stock return. So yeah, that's what she's reported here.
Bear with me for 1 second, Dr. Woolridge. Okay. In reviewing Ms. Bulkley's discovery responses, did you review RRU 163?
No.
Okay. Is that something that we can perhaps just pull on the screen for a minute? Oh. Okay, never mind. I'll withdraw that. Would you agree, subject to check, that Ms. Bulkley's response to RRU 163 indicates that the historical average market return from 1926 to 2021 is 12.34%?
Sorry, I'm just gonna have to object. The witness already indicated he hasn't reviewed that document, so we can't agree, subject to check what the content is.
Okay, fair enough. Now, your estimate of the market risk premium is based on survey data, correct?
It's based on 30, 40 different studies, but I primarily focused, and it includes, I mean, obviously I present the historic numbers so you can see where they are. You can see the ex ante models where primary academics, some investment professionals have estimated a market risk premium looking forward, and it's based on some surveys. And the surveys are just interesting, but I specify in my testimony the primary ones I looked at. I say, the historically 4 to 6% seems to be the norm of where it's been. Right now it's at the higher end, about 6%, but I use Kroll, I use KPMG, I use Demoteran. Demoteran's the investment education guru in the country. He's well known. It's from NYU, publishes a market risk premium every month. I use his approach too. So I use a lot of different sources, but much like Kroll, kind of here's the range. Where is it in the range? Right now it's at the top end of the range.
And from all that analysis, the survey data that you used incorporates various historical time periods, correct?
I don't understand what you mean.
Well, please turn to page 63 of your direct testimony.
Yes.
And on lines 18 to 19, it states in part, it should be noted that many of these studies, as indicated, use data over long periods of time, as long as 50 years, correct?
Oh yeah, I mean, some of these studies will look at data over time and estimate a market risk premium every year, and then build that into the model that they're looking forward. But like for some of these were published 15, 20 years ago. But they build models using historic data and then try to project the returns.
And for your market risk premium, you relied on your judgment, taking into consideration the range of market risk premium data provided from the various studies and other areas that you compiled, correct?
I agree. And again, I suggest the authority Google market equity risk premium and look at the sources you're going to find. They're going to be the ones I use. And you're going to find the results are pretty much in that line. I summarized it on page 64 of my testimony, the historic studies, the ex ante, the surveys, the different approaches that are used. And 4 to 6% is where most of these equity risk premium, they're certainly not at 9 or 10%.
Now, please turn to your direct testimony at page 56.
Yes.
And there you cite to Duff and Phelps, which is now Kroll, for their recommendation of a normalized risk-free interest rate of 3.50%, correct?
Yes.
Did you use the Duff and Phelps or Duff and Kroll normalized risk-free rate as your estimate of the risk-free rate?
Generally, I do. But this problem with the 20-year bond is clearly demonstrated. I demonstrated in my testimony at page 15, where I show the yield curve as of when I filed the testimony. By the way, the yield curve still looks like this. It's predicting a recession. If you've seen a negative, you've seen an inverted yield curve, as I show in the next page. Every time in the last 50 years we've had an inverted yield curve, we've had a recession within about a year. But yeah, I'm showing right here that you can see the liquidity impact of why suddenly at 20 years there's a hump in that. So I kind of use a combination of the 30 and the 20 and the 10 to kind of figure out what the long-term yield is. But it's obvious from that chart that there's a liquidity problem at 20 years.
And staying with page 56 of your direct testimony. So you also indicate that given the recent range of yields, I am using 3.60% as the risk-free rate, or RF, in my CAPM, correct?
That's correct.
And on that page, you also refer to a figure 5, which is a spot yield curve, correct?
Where do I think, where do I refer to? Oh, figure 5, the yield curve. Yeah, I refer to that yield curve, yeah.
And then here you note that the yields were in the range of 3.5% for 10 and 30-year Treasury yields to 3.7%, correct?
Yes.
And you've relied on this yield curve in your analysis of the yield curve, correct?
Well, I did in terms of, I relied on the numbers at the time, yes.
And in the past, PURA has taken into account changes in 30-year Treasury bond yields when setting an ROE for a utility, correct?
I'm not familiar if they have. I think I demonstrate pretty clearly on pages 23 and 24 of my testimony that in the last 5 or 6 years, authorized ROEs and interest rates don't have a one-to-one relationship in a big way.
So page 56 of your testimony further indicates that the 3.60% risk-free rate used in your CAPM is synchronized with the market risk premium, correct?
Yes.
And have you provided this analysis in a work paper in terms of any analysis that you've performed?
No. I mean, it's very similar to the Kroll approach. They synchronize risk-free rates and market risk premiums.
Now, in response to interrogatory UI-OCC-1, which asked you to provide the source materials for your work to synchronize the risk-free rate and the equity risk premium, or ERP, in the attachments, you provided a document entitled Client Alert, Duff & Phelps increases U.S. equity risk premium recommendation to 5.5%, effective January 31st, 2016, dated March 16th, 2016, correct?
I might have done that. I don't know. I mean, obviously that's historic, but when Duff & Phelps publishes these updates, I usually put them in my work papers because sometimes I'll refer to something they say in their report when they update the risk-free rate or the market risk premium. And yeah, in my testimony, obviously on page 7. Is it page? Yeah, page. Well, in my on page 7 of JRW6, I show the historic market risk premiums and risk-free rates that Kroll puts together for Duff & Phelps.
Would you agree, subject to check, though, that you provided that document as an attachment to a discovery response?
I very well could, because sometimes I'll refer to some of those old documents.
Do you have your discovery responses with you?
No, there's 50,000 pages. I didn't bring them.
Okay. Excuse me, Madam Chair, just one moment.
Okay.
Thank you. Thank you. So, Dr. Woolridge, as a document that you provided in response to interrogatory UI-OCC-1, would you agree, subject to check, that page 10 of that document you produced, in the 4th paragraph, it states the risk-free rate and the ERP are interrelated concepts. All ERP estimates are, by definition, developed in relation to the risk-free rate.
I agree with that.
So would you agree that this Duff and Phelps report demonstrates that the equity risk premium and the risk-free rate cannot be chosen independently, but rather that the equity risk premium must be related to the RF rate?
Well, and again, I don't know what you mean by be related. I think, in each situation is different. You look at the rates, you look at the market risk premiums, and you tie them together. So as much as you can, you try to relate them. Obviously, you can go to extremes when interest rates are 1% or 10%, and obviously you got to estimate those two things together.
Now, we discussed earlier that you would agree that Value Line is a source that is widely available to investors and commonly used by investors, correct?
I believe it is. I think it's a good standard source. Most academics look down on it. I think it's pretty good, but academics are a little snooty about stuff like that.
And putting academics aside, it's also widely used in regulatory proceedings, correct?
I agree.
Are you aware that Value Line reports beta coefficients?
Beta, oh yes, they actually report several different beta. I mean, there's one on the standard page, but also they have other betas. If you subscribe to their service, you can see their 3-year beta. There, different levels of beta, and they're adjusted betas, so they're not raw betas. They've adjusted them upwards.
And in fact, you've relied on Value Line as your source of beta coefficients, correct?
I have, and if you look at, I'll give you a good example. Take a look at. I update this study. I want to highlight this. There's something going on with Value Line betas, and I haven't figured it out. I haven't had the time to dig into it. But if just since Value Line beta came up with Ms. Bulkey's cross and mine, I always put this study together. I'm sorry, I'll find it. I put this study together every year. It's table 7 on page 37 that shows the average industry betas for all the companies, 1,700 companies covered by Value Line. And I took the average, and obviously the utilities are lower risk, but the average beta for Value Line is 1.11. It's not 1.0. And the reason is they don't use the S&P 500 as their market index. They use the New York Stock Exchange as a market index. Most tech stocks, which are riskier stocks, are not on the New York Stock Exchange. And that's why I think the betas are inflated. The Value Line betas are inflated. I'm trying to figure out how. I'm working on a study of betas to figure out why the market beta is supposed to be 1. Their average beta is 1.11. I haven't figured out why. I've called Value Line. I've asked them about it. I said, why is this? They haven't responded.
In all the betas that Value Line reports on, do they report any option implied betas?
I'm not aware of them. I'm not aware of them reporting those.
Does Value Line report any forward betas of any kind?
Not that I'm aware of.
Are you aware that Yahoo Finance, Bloomberg, Google Finance, Reuters, Morningstar, Capital IQ, MarketWatch, and CompuStat report beta coefficients as well?
I agree. And many of them are much different than these because, first of all, they use different time periods. They use different, whether they use monthly data or weekly data. They use some of them like that. Yahoo doesn't use the adjustment that Value Line and Bloomberg uses. So betas are really kind of, if you look at a collection of betas, certainly the Value Line betas I think are higher than many of the others, but I haven't done a study on that.
Do any of the sources that I just mentioned to you report option implied betas?
I don't know.
And do any of those sources, as far as you're aware, report forward betas?
I don't know.
And have you ever relied on option implied betas or forward betas of any kind?
I have not, but maybe I should look at them.
Now, in selecting your ROE recommendation, you provided a range of 8.70% to 9.30%, correct?
I want to double check that. Yes.
And within that range, you selected a specific recommended ROE right in the middle of the range at 9.0%, correct?
No, I didn't. I mean, I took that range. One of the things about that range is UI is a little less risky than the proxy groups. So I kind of looked at the range and kind of went to a little below the norm of the range because it's less risky. These companies we're using have an average S&P rating of BBB plus. UI has an average, has a S&P rating of A minus. So it's a little less risky. So I consider the risk of the company within the range.
And thank you for the clarification, and I apologize. My question is more from the mathematical standpoint, though. 9.0 is the midpoint of 8.7 and 9.3, correct?
It is. Good point.
Now, in the past, you've selected the top end of your recommended ROE range by citing the recent rises in interest rates, correct?
I have in the past, and the range is the number. Ms. Balke and I, we do the same thing. We use judgment when we pick a range, and then where we put the number within that range. And I agree. It's a matter of market factors, that sort of thing. As I specify in my survey testimony, during the pandemic, interest rates were so low, some of the CAPM numbers were so low. I relied almost exclusively on DCF numbers. Now, the interest rates are becoming more in line where they've been historically. I'll use both approaches, but I still prefer the DCF approach.
Interest rates have continued to increase, correct? Is that a fair assessment?
No. They peaked last October. From the lows of 2020, they peaked last October. They've dropped off since then, but they go up and go down.
Go up, go down. Recently, they've gone up.
They have gone up some, but this is after they really peaked in October. That's when that's when the 30-year was at 4.5%. It went down to 3.6 or 3.5%. Now it's at 3.9%. So it has come back up a little bit. Okay. And the irony is in 2023, for example, I saw Seeking Alpha just had an article the other day. If you look at utilities, they've outperformed the S&P by 100 basis points in 2023. So in this tough environment, they're still hanging in there pretty well.
Okay. Thank you, Dr. Woolridge. I don't have any further questions.
Okay, very good. In that case, we will take our lunch break. When we resume at 1:00, we will resume with cross for Dr. Woolridge by authority staff. Thank you.
I'm sorry, Chairman, I might have missed it. When are we coming back from lunch? Thank you.
That was a tough one. Was that not your fault? I come back in the comments are weird, right? So it was hard to like. 4 minutes? 4 minutes? No, that's way easier. I forget that. I thought this is tough. This was really exactly. It was like all Rarely, I'm gonna be Sorry, I'll just have to do the whole morning.
Right, so like, I think, like, some of it is, repetitive, you just put together, it might just be easier to take it out and do it.
That's right.
I think it's sweet then. And I would be cross on her. It was like Yeah, me too. Yeah. Yeah, I mean, I hope I took the right. Right. I didn't want to bother him. He's like, oh no. Yeah. Yeah. So we were busy. Hello?
Hi, how are you guys doing?
Good, how are you?
Hanging in there. Almost there.
Almost done with these, right?
Oh, yeah, hopefully today. I might be asking.
Yeah, they're good. So, you been listening? Well, no, I didn't. Mom, just finished, we're done. Okay, so read them, yeah. 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 So they might finish or have a short morning. She's going. Yeah. Yeah. Really? I don't remember. Yeah. I had it remote thing. I have a little bit. Yeah. Oh, okay. So what do? Do you just work until it's done or do you go to bed? No, I can't. I work until like 1 is the cutoff. Yeah. And then I go to bed and then I get up and I finish at 11 o'clock. Otherwise I would feel. Yeah, that would be, I would be thinking, I can't usually like 2 o'clock. Yeah. And then. If I'm really on a roll and I'm good, yeah, I'm not caught already. And I get that 4 hours or 2, but generally I try to do it. Yeah. We want to 5 hours, 4 hours. So that. Function. Yeah, right. That's my goal. Because you come back from the office. Right. Yeah. I think it was beautiful for me. Yeah. But it was, yes, it was my best day. Yeah, I think, yeah. Compared to the one previous guy, it's like. It's different. It is. And it's so weird how much it changes. They're carnival. No, I can't because I'm old. I'm old. My dental work, I don't want to lose tooth or filling on caramel unless I suck on it. Well, they're hard caramel. They're not soft. I've been eating M&M's. I'm on the whole. Oh, really? Oh, they're hard? Yeah, they're hard ones. Oh, all right. Okay. All right. You shaved out. I'm a big fan for that, especially when I'm doing it for like sitting and hair and coffee and yeah. Okay. I have this weird thing over here. So now I'm going to play and go up and go away. Today happens to be like a full day, and I'm like, yeah, it's weird. So weird. This weird. Yeah. It's weird, like water. Yeah. I have the same. Yeah. So I don't understand. I think it just won't go away. Yeah, the cold is. I've had it different years. Yeah. The machine. Yeah. I've had it done every day. I've always had problems with my ears, so it drives me insane when I'm like, I'm 40 at this point. I should still be having this problem. Baby. 1 year. Right. not. Yeah. And I'm, yeah, yep. That's like that. I'm black for having big life for me. I just like that. Such a big kid. Get on the treadmill. Yeah. I was like,
No,
now
you
you're
don't,
kidding.
no, there's no exercise.
You're all more for them. Oh, like it's only been 3 weeks. Just because I'm sitting 24 hours a day. Yeah, I mean, hard to sit. That's why. Yep. Yeah, I bought myself a standing desk, like just to try out and like sit on top of my desk.
Yeah, that's nice.
Because especially when I'm sitting all day and then like I sit for like the next like several hours.
Yeah.
So I spent the first probably like 2 hours standing working. And then
So you get tired then.
I do. Well, especially because by that point, like everything's hard, but it's funny because like then you go to like sit down to work and I'm oh, we're relaxing and then I get tired. And I'm like, I should probably just dance the whole time I'm doing it. So like then my limbs are like,
I know.
like I want to sit down.
All right, I got it. All right.
So I won't see you tomorrow.
Right.
So I will be here at 9. Yeah. I sent you my last patient. Yes, I saw it.
Thank you. Appreciate that.
Yeah.
And so the week after, a lot of late files.
I'm like, it's funny, even that one day that I wasn't there, then we jumped up like something.
Yeah.
So how many years left to do it? Was there a lot or no?
No, about the showing now.
All right.
It's the read-in, it's my mom, she can look at.
I was wondering that too. I had to argue. I was like, well, I haven't been doing it. Because they're both writing it down. So I was writing down the visual, they're right. That was whatever is action. Because I was thinking that too.
You never used to do it.
Yeah.
Late files.
No, we didn't, I never did either. And all of a sudden, they were like it.
Yeah. Yeah, you know, it was Rob's fault. He started doing, I'm pretty sure it was his.
Yeah.
When we started doing this again, Dr. Luke started working with
Yeah.
Brenda. I think he started doing that, and then they liked it.
And it took off.
Yeah. So the week after, I don't know, are they on the Monday week
I
after?
think it starts in the middle of the week on that.
Yeah, okay. Monday, I'm here to do something else.
Wednesday, maybe?
Yeah.
Tuesday or Wednesday? I could be wrong about that though. And they're in person, right?
The late files, I don't know. I didn't check. I just saw it on the schedule.
I'm pretty sure they are.
Yeah, so I don't know, but if you have any, she has you on all day or something.
Okay, well, originally I said I'd take the very last day, like the last day, and then I'll do the whole day, but then we added another day. That's all, it all depends, like if we're gonna go all day, I can't.
Oh, so the late files added? I haven't really compared it to
Or
the
no,
schedule.
she might have had a schedule, and then I was like, I'm pretty sure there's pretty, I think she did come away, and I'm like, I just wanna make sure that you have all, however many days, or if it's, I feel like there's one that they can schedule. She's like, oh yeah, she's putting everything there, yeah, I'm like, okay.
Well, put it in there, please.
Darn, you know, but I thought, all right, yeah. I'm just like, there's a lot of them, I said, so they may even add, I didn't know how to go. They may even add, but.
That'll be interesting.
Yeah.
It's like this week.
Yeah.
All right.
Will be.
Take care, you too.
Thank you. Have a great night.
Yeah, exactly. Good point, yeah.
Feel your pain with driving in the winter on that.
Well, I know that 80, 81, 84 route very well.
Yeah.
This time, I made it from State College to here for 4 hours, 45 minutes.
That's not bad.
Yeah. That was the new hotel. Oh, Sobe, you gotta send everybody there.
That's good.
What it is, they upgraded it. It's a Fairfield, whatever.
Yeah.
But they put this huge restaurant with a great bar. They have a bar that seats like 50 people.
Really? Yeah.
And it's a very upbeat, it's a happening place. You can
Okay.
tell everything's modern design.
Okay.
Send everybody there. It's close, it's cheap.
Okay, good.
And they have a phenomenal bar. And also there's a lot of people around it.
Yeah.
But they have, the restaurant's called Custom Kitchen something. It is great.
Okay.
But yeah, tell those guys that that's where they should go.
Okay. Randy's recommending the Fairfield Inn in Plainville as the place to have your consultants stay.
It is really a good spot, really nice. They have a great custom kitchen in there with a really good, a menu that's so good.
Where is it? Plainville.
Yeah.
It's right off the highway, right?
Right. Oh yeah, it's nice. Really a nice place.
Okay, I think we are ready to go back on the record. So we're going to resume cross here of the OCC's panel by authority staff. So Ms. Skirris, please. Oh, I'm sorry, Ms. Skirris, no rush.
Hello.
Hello. Oh, you know what? I'll use this. Sorry. Okay. Good morning, afternoon. It's Rita Skiris with Authority Staff. Dr. Woolridge, we're going to be looking at your interrogatory responses and probably your SIR rebuttal mostly if you want to pull that up. But first question to the OCC is regarding OCC response to RRU 332 attachment A, which was actually a question that asked OCC to respond to particulars of RRU 95 through 101. There was a indication that OCC would be updating those, and I just wanted to make sure OCC had the opportunity to look at those and see if there anything you find needs to be supplemented.
Which number are you looking at?
It's RRU 332. It's attachment A.
That wasn't my.
It is.
I had RRU, well,
It is an OCC question. It's a.
I didn't answer it.
Well, maybe
Oh.
these people did for you. Because it's actually 332, and then it's an attachment A, and it goes through RRU 95 through 101. And initially it was responded to saying that would be handled in the pre-filed testimonies. Just want to make sure that we do get those.
What is the question?
The question is has the opportunity had to relook at this response and just indicate to us if anything it needs to be replied to or supplemented?
I think I understand the question. Are you referencing a request for certain like periodical reports
Correct.
to be updated?
If you thought it was necessary at this point.
The one thing we've updated is we continue to send when the RRA reports come out, we send you those.
I haven't seen that, so there hasn't been an update on that, other than what was filed in the RRU 332.
Did you get the 2022 ROE's report?
Is that it updated in 332, or where did you update them?
You can read that in. We did update the RRA up until the end of the year, the last report that came out in January.
Okay.
The next quarterly update won't come out until April.
Okay.
And we've been providing the blue chip updates. We do have one piece from March but the next piece won't come out until next week, so we were waiting to file the two pieces, both the financial forecast and the economic indicators, until we had both pieces for the month.
I see. And where,
All those have been updated as they came in each month.
where have they been updated, please?
Whatever interrogatory response or supplemental response filed.
Because it appears here, you know, it maybe should have been provided in the RRU 332. So you're responding them to the original one, 90.
It might have been to 93.
5.
It wasn't the 90s. It might have been.
Okay, all right, thanks.
But we'll check and read.
Yeah, if you can check and tell us. So, okay, so 95 was blue chip, and then 96 is the RRA major rate case decisions. So is that where you think you're filing them?
I'm pretty sure those were, but we will check.
Okay, thanks. Next question. Earlier today, Dr. Woolridge, there was some discussion about you were updating a table from your pre-filed testimony. You provided the numbers 3.11 and average daily. I think that was a treasury rate. Is that correct?
Yeah, it's the same numbers. I just, because I knew you would want them, so that's why I did it.
Okay, and where did you do that? Because did you provide that as a separate
No,
exhibit?
I just read it in.
Okay.
I was just reading in the data because I knew you would insist on seeing it.
Okay. Is there a table maybe you can give us a supplement with that?
I will provide an updated table, yes.
Okay.
An updated table, I'm sorry.
Based on what he testified to
Yeah.
earlier with, if you could just give it to us, so it's not just read in the record. Yes.
This would be, I believe, an update on to the table that's on page 21 of Dr. Woolridge's direct testimony that shows interest rates and allowed ROEs. Is that the request?
Sounds right. Thank you.
Yeah, table 5.
Thank you. So that can just be filed as a supplement to the testimony, please.
Thank you.
Dr. Woolridge, on pages 16 and 17 of your testimony and page 5 of Sir rebuttal, this goes to your discussion here on ROEs declining by 20 basis points while the U.S. Treasury 30-year declined by over 150 basis points. Is it correct to interpret your observation here is that regulatory commissions lag to implement trends in economic indicators with respect to the Treasury rate as they were declining over this time period?
Certainly, I mean, and obviously 2020, 2021, when interest rates hit historic lows, authorized ROEs hit historic lows too, but they didn't decline by 150 basis points like 30-year Treasury yield. They declined by much less, like 15 or 20 basis points. And I'm just saying that, you know, this relationship between the Treasury yields and authorized ROEs is not real strong, or not nearly as strong as you normally would think. You would think interest rates go up and down. You would think authorized ROEs should go up and down. They didn't do that.
Do you feel that there's some kind of reluctance on the part of regulatory commissions to grant allowed returns below some perceived threshold?
Well, I think you should refer to page 23 and 24 of my testimony, where I highlight the Werner and Jarvis article. Actually, this was a Wall Street Journal article came out, said utilities have a high wire act ahead, and basically it was talking about, you know, utilities have had it pretty nice for a long time in terms of low interest rates, low gas prices. Now suddenly we're going to have higher interest rates, higher gas prices, and suddenly electric rates are going to go way up, and they're going to get a lot of heat for it. And so as part of that, they also cited this Werner and Jarvis study, which shows that over time, authorized ROEs never came down to reflect the cost, equity cost rates, and they estimate a number of things. But on page 23 and 24, I provide a very detailed summary of that study. It's worth reading, I think, but it's pretty interesting that came out just before we filed testimony in this case.
Thanks. Sticking with this topic again, with the rates, ROEs coming down, but not as quickly as the U.S. Treasury rates. Do you feel that on the way, let's say hypothetically, if rates are increasing, that how do you feel that the ROEs should go? Do you feel that they should as well?
Well, I'm
Since they
not
moved
saying
downwards.
I'm not saying what should happen. I said this is what has happened,
Yeah.
and so I'm just referring the fact that they never went down when interest rates went down. Now they're going up. It doesn't mean they have to go up by 150 basis points. That's the
Right.
point I'm making.
So you feel that they could move up slower than?
Well, I think
trail?
they have. I mean, I'm not predicting. I'm just saying this is how it's happened. And yeah, last year the 30-year Treasury went up 105 basis points. Authorized ROEs for electric utilities went up 16 basis points. Authorized ROEs for electric distribution companies like UI only went up 6 basis points.
Okay, so you feel that the trend has been consistent then?
Yeah, I mean, they
down?
didn't go down when interest rates went down. That doesn't mean they should shoot way up when interest rates go up.
Okay. If we open up, maybe you'll recall this right offhand, but in RRU 332, the response there that was for attachment, the RRU 96 attachment. There's a whole bunch of them. One interest. Can you find it?
I'm sorry.
It's the response is RRU 332, and then there's a sub response there that goes to RRU 96 attachment B. And we're going to go to page 7 of B, if you can find it. But in a review there on page 7, there's a item called capital structure trends. And according to that article of the RRU at that time period, the average capitalization mix for companies is now 50.26 subject to check for the authorized allowed ROE equity portion in the capital structure. Have you had a chance to look at that? And
I don't know what time period you're talking about. I don't know what document you're talking about. If you could bring it up, it'd be helpful.
okay. It's the OCC's response to RRU 332.
Yeah, just for, I apologize, Ms. Garris, just for clarification, these two responses to, I believe, RRU 95 and 96 are requesting documents to which OCC as an agency has a subscription. So these documents didn't come directly from Dr. Woolridge.
Oh, okay.
I'm not sure. I mean, Dr. Woolridge could certainly testify as to his awareness, if it exists, as to what's in those documents, but just trying to clarify for any.
We'll move on from that.
I think we have a camera problem here.
Yeah. One thing I noticed here with the attachment to the RRU 99 that was responded to in 332, I did not find the Motorin exhibit attached. Could we look into that and maybe supplement the record to make sure that the Demoterin reference is included?
I apologize. Could you just say the?
Okay. It's under RRU 332, attachment A, which is responding to RRU 99, which is the Demoterin article and any update. So the article itself was not attached.
Yes, well, we will track that down and read in or supplement.
Yeah, supplement it for us if you would
Yes.
mind, just to make sure it's in the record.
Certainly.
I mean, they're pretty easy to find. Just Google it, you'll find it right away.
Yeah, but I need it in the record.
Okay, very good.
Okay. Let's move on to capital structure mix. There's here a debate at Ms. Bulkley's rebuttal, pages 61 to 64, and your rebuttal at pages 3, 24, and 25. RRU and response, OCC response to RRU 378. And question here is regarding the OCC's recommended 50-50 capitalization mix. Has the witness had the opportunity to review RRU UI's responses to RRU 6, 7, and 8?
I don't have those.
Oh, you don't have those. Those are responses where the company provided some credit rating matrices.
I don't have those, that response.
Okay, so you have not had the chance to look at those?
No.
Maybe we can do this in more of a general format. Based on your experience, given the recommendations that you've made with the capital structure and the proposed ROE of 9%, from the credit rating perspective and any interactions you may have with the analysts there, do you feel that recommendation would provide some threat to the company in terms of their credit ratings or matrices, financial ratios?
I generally don't believe so. I mean, on page 9, table 3, I looked at, UI's financial performance, and one thing is very stable. You look at kind of their revenues, they grew during the pandemic, their net income growth, based on the regulatory structure here, and UI's financial performance, their numbers are great. I mean, they look very solid. I highlight their cash flow covers their CapEx. These are things that are important, and so I mean, they've done this with their 50-50 capital structure.
Okay, and I don't know if you were here to hear, but the other day it appeared that the rating agencies were familiar and found that the 50-50 capital structure kind of like consistent in a way that.
Well, and they do like consistency. I mean, I'm sure the company would like a higher equity ratio, but I mean, the company's operated very well with its current capitalization.
Okay. I just want to flag this for OCC in response to RRU 378, and this is not a question. When you filed your testimony, you did, in terms of the cost of the debt, you picked up wrong numbers, it appeared. So I want to make sure that that is revised in your brief or whatever.
Okay, thank you.
So
I think I picked up the original ones. Maybe there was an update that I missed.
I'm hearing that we did file a response with a correction there, but we can double check that and supplement that response as well.
Do you know the response?
I assume it would have been RRU 378, but I can't confirm that.
That's the correction, but I wanted to make sure that's picked up by the witness. Okay, earlier yesterday, I asked the company a series of questions about incorporation of the short-term debt component into the rate-making capital structure. Were you present then? Did you?
I was there. Yes, I was.
In this docket, you have not incorporated short-term debt as a separate class of capital for rate-making purposes. Can you explain why?
Yeah, because the company hasn't used much short-term debt. They've used very little in the last couple of years. When I incorporate short-term debt into a capital structure, it's usually because they've extensively relied on short-term debt. And really, the situation that happens when you go back and look at their capitalization relative to their rate base, And all you have to do is look at their long-term debt and their equity capital, and does that cover their rate base? And if it doesn't, they're using short-term debt to finance rate base. And then you should definitely incorporate short-term debt into the capitalization. But no, they haven't done that either. So there's no reason to put short-term debt into their capital structure.
Okay. Well, in other jurisdictions, have you recommended?
Oh, yeah. And some states, like you go up to Massachusetts, they say no short-term debt, whatever. Other states do. New Hampshire does, for example. Maine does. So some states use it, sometimes don't. It really depends on their regulatory principles and that sort of thing. And when I look at a utility, look at equity ratio, look at how much short-term debt they use. Does their long-term capitalization cover their rate base? Those are things you look at.
So in this position, you
No.
would not, no. Okay. Earlier today, there was a exhibit I put up with different companies. There was OCC provides a proxy group of 25 companies. I'm sorry, 23 companies. Is that correct?
24.
24. These include the following: Con Ed, Dominion, WC Energy, Hawaii Electric, and Pinnacle. Subject to check, those companies were in the last PURA allowed proxy group in 160604. Can you explain why you included them in the 220808 proxy group and identify any screening selections that you relied upon that also concur with what your understanding is of the PURA selection process?
Yeah, I've testified here, I don't know how many years, and whatever PURA kind of evolves over time, and whether it's different folks, whatever. So I really don't know what their guidelines are. I use 50% as revenue. Ms. Bulkey has a different, so we have slightly different proxy groups. I like a larger proxy group because get a better measure of the required return numbers and that sort of thing. A larger group averages out the errors better and that sort of thing. And then I use their credit rating, say, well, if the average credit rating is BBB plus, as is in this case, UI's credit rating is A minus. That means UI is a little less risky than their group. And so I account for that in that way.
Okay. So your difference here that allowed these into your proxy group is probably the gross revenue threshold of 50.
Well, I think, yeah. Ms. Walker uses a couple, 70% from regulated operations. That's right. I just use 50% of revenue. And obviously, these are all electric utilities as identified by value line and that sort of thing.
Just to clarify, you're saying it's 50% of electric revenue from gross revenue.
50% of regulated electric revenues as a percent of gross revenues, because these, some of these holding companies, their regulated revenues are 30%, so they're not going to pass my screen.
Okay. So you think that applies to most of these?
Yeah, that's all. Pretty much all of them, I'm sure.
Okay. The other question I had with her was the otter tail. Did you hear that cross-examination?
I did. I didn't. I was sitting in the back. It was a little tough to hear back there. I had to go back to my computer to hear it. But yeah, I didn't understand what it was. Otter tail. I eliminate them because their percent of regulated electric revenues are below 50%.
Okay. Now, her question had to do, there was something there about the plastics company. Once you got rid of the plastics company, then it passed her threshold.
Hers or mine?
Hers.
Oh, I don't know.
She included it.
I don't know. I don't know that.
Okay, so you missed that bit. So this was excluded by you solely on your screening of 50%.
Yes. And if they drop, and typically some companies will come in and out because if they divest or sell off a division, turns out suddenly maybe their regular revenues go up to 50%. So they may come in after I update it for 2022 data.
All right, there was another group of questions I had with Proxy Company, and those were related to the Rothschild Leaps Company, which in that exhibit we had, I'll just tell them, CenterPoint Energy, Exelon, First Energy, PPL Corp, and Sempra. Those were not selected by you. Do you have an idea as to why?
Which ones?
CenterPoint Energy.
CenterPoint has done a bunch of divestment, so they're in some cases they don't even have earnings forecasts. I'm not sure about all these. Let's see, who
There's
else?
Exelon.
Exelon has, they divested a bunch of things, and it was within the last year or so.
What about First Energy?
First Energy, well, they were in triple B, no, double B bond rating territory at one point.
So they're
working at getting back up.
too
Yeah,
low of a,
yeah, they didn't meet the credit criteria.
okay. And then the other two were PPL and Sempra.
Sempra, I don't think they meet the 50% thing, and PPL, I'm not sure. They sold off some their English assets and that sort of thing. So I think that's why they were out.
Okay, great. Thanks. If you reference, actually, it's a OCC response to UI 0101, which is your data submission. When I opened up that exhibit, this has your Zacks, Yahoo, and S&P IO growth rates in an Excel spreadsheet format. First of all, you're the only witness in this case that is providing S&P IO. Is that right?
Capital IQ, yeah.
Yes.
Yeah.
Yes. Okay. When I opened that up, I found some water companies in there, and I was wondering why you have water companies.
Well, this is a monthly update I do where I gather all this data, and I include my gas companies and water companies, in case one of those cases come up.
Oh, I see.
It was intended as just part of the data gathering.
Okay, the tab here says it's done at 12/12/22.
Yeah.
Right.
Mm-hmm.
Based on my review here, I didn't find any hard copy backups, like you didn't provide the print off.
Right.
Is that how you just provide
Right.
the thing? Now, you did do a SIR rebuttal to Ms. Buckley dated 1/17/23.
Yes.
I know that discussion of the growth rates is mostly of a theoretical nature, beginning on page 7 through 14 of the SIR rebuttal. When you did your SIR rebuttal, did you actually go through and kind of recompute your numbers physically? For example, would you have a growth rate for your companies of the 25 companies that you have in the Proxy group?
When I did my SIR rebuttal? No, I filed my SIR rebuttal a month after I filed my initial testimony. It wasn't a month later, it isn't worth updating.
Okay, so that was my next question.
Just the way this case came. You filed your direct testimony, and then a month later, I'm already at SIR rebuttal. It moves pretty quickly.
Mm-hmm. Based on the current, I guess, market situation, you just indicated from 1 month to the other, you didn't really find any difference and worthwhile updating the growth rates. Do you think?
Well, the growth rate, you have to realize, you have to understand how these analysts work. Typically, a lot of the growth rate changes occur usually in about February, because companies announce their fourth quarter earnings, then analysts update their models, and then they make projections for the future. So a lot of changes have occurred now from the beginning of the year because everybody's reported earnings. So yeah, I've just filed testimony in Oklahoma with updated numbers, and I'm still at 9% ROE. But because right now, I mean, and I think between December, when we filed our initial testimony, and now, every one of those, almost all of those growth rate numbers have changed. And that's just because January and February is when analysts take their fourth quarter numbers and update their models and come out with new projections.
Okay, it sounds like it might be worthwhile to get an update of your exhibit.
I verbally gave the exhibit earlier. I said, that's what I said. What's happened since we filed? Number two things have happened. Number one, dividend yields have come down to about 3.5%. Number two, the growth rates are pretty much the same. They go up and down. A lot of companies, individual companies' growth rates have changed, but the averages are still about where they were when I filed my testimony.
Okay, the averages are the same.
Yeah.
Would it be feasible for you to provide an update to that Yahoo, Zacks, and S&PIO exhibit?
As of what date? You have to give me a date, because I mean, I do this on, you have to give me a date I need to update.
Okay, I guess you did it December 12. How about today's the end of February?
Okay, no, that's fine. No, I'll do that.
February, whatever is that, the last date, the 28th?
And Ms. Scaris, that exhibit, that's what's filed in UIOCC 1, is that correct?
Yeah, it's a document there. It's identified as Zacks. Yeah.
So you want the Zacks, the Yahoo, and the S&P growth rates updated, right?
S&P IQ, as you call it.
Right.
For your company, if possible, could you also give us the ones for the identified ones that didn't meet your threshold, the Con Ed, Dominion,
Yes.
WEC,
Okay.
Hawaii, Pinnacle?
No, I had all those in mind. Those were in my
They're
group.
in there. Yes, those are yours. That's correct.
Oh, okay. Okay, so I think it sounds like I'm going to make that late file exhibit 142. So, Attorney Wheel, did you say it was OCC UI 01? Is that the?
And you want the updated growth rate numbers as of, like, say, March 1st, okay?
Yeah, right. Well, that would
Okay.
be the day before the February 28th.
Okay, S&P, Cap IQ, and no, Cap IQ, Zacks, and Yahoo, right?
Whatever you have in that.
Okay.
Just the same thing at a different date.
Yes, Chairman, it's UIOCC 1. That filing has literally hundreds of documents. It's the filing requesting Dr. Woolridge's work papers. So it's requesting an update to one particular file within that filing, which is identified as Yahoo Zacks IO. Is that correct, Ms. Chris?
Yeah, something like that.
Yahoo. Okay, so if that's understood, I'm just going to mark the prompt as to provide an update to the exhibit as of 2/28/23 with that.
Yes, understood. Thank you.
Thank you.
Now I have if you guys are ready, I can move on. Regarding your DCF approach, if we reference the Woolridge pages, pre-file testimony pages 52 through 54, Sir rebuttal at pages 10 and 11, and also response to RRU 388. Just to summarize here your response, there's a discussion here that you have, I believe, included the SV portion of the sustainable growth equation. You indicate I have also used value lines projected book value per share growth. This growth rate calculation includes value lines estimate of sustainable growth, which presumably includes BR and SV. Do you recall that?
Yes.
Regarding the value lines projected book value per share, I'm assuming what you're saying here is the small boxes on the value line exhibit that has, begins with 10-year, 5-year historic, and then does a projection
Yes,
column
that's
for
right.
the next 3 to 5 years.
Yes,
And your book value per share, you're picking up that growth rate, correct?
that's correct.
And if you clarify what you mean by presumably include the BR times SV, is it your belief that value lines algorithms have some assumption built into the model where it kind of has a estimate of when the company would be issuing equity?
Well, yes, because obviously if you're using the PR plus SV approach to this, obviously the SV is based on future stock sales and the price of future stock sales to figure out, the additions to book value. I mean, that's speculative, but if you use this approach, everybody I've seen use this approach uses value lines projections for the number of shares outstanding and for the price per share, that sort of thing. So as a result, obviously if value lines also projecting the growth rate and book value per share and including the SV factor, they're doing the same thing.
Okay, thanks. Now, CAPM model, you have incorporated CAPM into your analysis, but to the best of my knowledge, I don't know if you assign a percentage or weight to it. Can you maybe give us some guidance as to how much you would recommend weighting the CAPM in this economic environment?
Yeah, I mean, I've always primarily used DCF, whether it's, 75% DCF, 25, I don't know, it's probably about that. In different situations, I mean, obviously during the pandemic, I gave very little weight to the CAPM, just the numbers were so low, bless you.
Thank you.
But and then now that things are more normal in terms of interest rates, I think that's going to get much more attention to investors and incorporate that into their return requirements.
In terms of CAPM market risk premium,
The market risk premium is the biggest mystery in finance, just so you know that.
yes, I didn't get to the question. This is more of a technical issue, and in reviewing the response to RRU 371 and comparing to Woolridge pre-file testimony pages 63, 67, exhibit JRW 6, when I looked at your narrative compared to your Woolridge exhibit of JRW 6, it appeared that the words in the narrative were not matching the numbers from the exhibit. And I'll give an example. For the Kroll, Duff, and Phelps, in the narrative, you've correctly identified the current figure as 6%. But if I go to that exhibit, the Kroll, Duff, and Phelps remains at 5.5.
Okay, but yeah, I updated my narrative.
Okay.
It wasn't because they switched it last year. Yeah.
Right. And the same thing with some other items in that exhibit JRW 6.
Yeah.
Could we maybe assign a late file here to make sure that the narrative and the exhibit are updated?
Okay.
So
that's an easy update. Yes.
Okay. So what should we call this? Correction to exhibit JRW 6?
Yes, we would understand that prompt.
Slate file exhibit 143.
Another question for you. Earlier today, there was discussion of Kroll cost of capital navigator. Do you have access to the navigator? And if you do, I would ask if you could provide us maybe with Kroll's supply side recommendation.
I don't have the access to the navigator.
Um, Okay, in your Sir rebuttal now, pages 17 and 18, where we were discussing the Ms. Bulky's analysis to develop ERP in the CAPM, subject to check that range that she's come up with is the 9.14 to 9.78. Earlier, you probably heard me ask her a few questions about this range. Based upon your review, you're finding that the assumptions regarding future economic earnings growth and stock return are unrealistic in that approach that yielded the range of 9.14 to 9.78. Is that correct?
Yes.
Can you recall a time period where the U.S. expected market return achieved the 12.94% as proposed by the calculations of the company?
I don't understand your question.
Well, I mean, to get that 9.14 to 9.78, there's the other side to it, because you're taking the market return less the risk-free rate to get the expected ERP. So to get that, we are looking at a market return much higher than the 9.14. Isn't that right?
9.14. I mean, not so. 9.14. That market risk premium is based on a projected interest rate. The market risk premium is based on the current interest rate, not a projected rate. So that's why I when I talk about the market risk premium, I think the number was 9.58%, I believe. But it's based on the current, not the projected.
Okay. So the issue here that you have is the use of these projected.
No. The issue is the size of the market risk premium, which is based on expected market return, which is, I feel, overstated. And the reason in my testimony, I say, why is it overstated? Well, you apply the DCF to the S&P 500, and you're using a growth earnings per share growth rate 11.14%, and that gets you the big return. And that's all covered by testimony.
Thanks. If we now move on to your rebuttal at pages 19 and 21, there's an indication here that the U.S. economy has grown between 4 and 4.5%. Is that correct?
I'm sorry, what pages?
Rebuttal is pages 19 and 21.
Oh, okay.
And this is getting into the country growth.
Yeah.
Okay. So your experience is that the U.S. economy grows between 4 and 4.5%. In order for that, is that correct?
No, if you look at my direct testimony, I lay that out. I look at historically, GDP growth has been 6%, 6 to 7%, if you look at nominal figures. However, over the decades, that growth rate has been declining. And now it's back to like the 4 to 4.5%. But if you also then, I say, you look at long-term projections from the Social Security, from the other sources who do long-term GDP growth rate projections, those projections are between 4 and 4.5%. That's all in my testimony, and I lay that out. And so, the reason primarily is the growth in GDP is a function of two things: the growth in the population, or the number of workers, and the growth in productivity. And both of them are very stagnant because the U.S. population growth is really slowing down. That means you're not going to have as many workers out there producing goods and services. So GDP growth is going to slow because you're going to have fewer workers doing it, unless you have a big spike in productivity. And productivity growth hasn't changed in a long time. It's about 1.8%.
In your response to the RRU 398, you basically indicated that the level of national GDP growth that would comport with Ms. Buckley's recommendation of the market risk premium would more comport with a company that has, or a nation that has a excess of 6%.
Oh, yeah, I mean, the point being is, I mean, I cite GDP growth and EPS growth are very closely tied. And if you don't believe me, I show it in my testimony historically. If you don't believe me, I cite Milton Friedman, who else? Warren Buffett, Jeremy Siegel. There's a tie between earnings growth and GDP growth. So long term, that's going to be, they have to be tied together.
Okay. In that case, I mean, if that market risk premium that is more associated with 6%, wouldn't that be associated with companies? I mean, countries that are growth countries like the lesser developed.
Oh, I know, and they achieve these for a short period of time, then they slow down.
So I guess my next question to you is: the U.S. is not in that type of situation,
No.
more or less. Okay.
And that's why, obviously Social Security has to have a long-term model of the economy, trying to predict what benefits they're going to have to pay, what taxes they're going to have to collect. And they do these studies of the long term, and they look at, last I looked, they have 198 economists working at Social Security. So they have a lot of people to contribute to these projections.
In OCC 401, you have that the investor required return for the United States is 5.6 subject to check. You've testified that your position is that the electric utility industry is one of the lowest risk industries, followed by value line. Is that correct?
Yeah, I mean, it's a low risk industry. I mean, obviously, with so much regulation, it should be low risk.
And with, is it your contention then that 5.6% identified through the Demoterin estimate is essentially a cap on the required return?
I don't know if I'd say so much that, but I just, I mean, all I'm doing in this table is saying, a huge, when a market risk premium being very high would be a market was very volatile or very risky. And, obviously you're going to find that in Africa and places like that. But so these are just some numbers I found in a table just to highlight different parts of the world where economic growth is and is not.
Next question is more of a CAPM theoretical question. There is a response to a UI response to RRU 169. I don't know if you had a chance. I think you.
Which one?
RRU 169. It's a UI response. It's not your.
UI to UI?
Yeah.
No, I don't have that.
Maybe we can ask this a different way. Given the current interest rate environment and movements, can you kind of, in general, explain how those movements would influence your CAPM analysis in a more general way?
I don't understand. I mean, I generally follow I follow kind of Kroll's normalized risk-free rate, and right now, if I was filing testimony today, I'd use 3.9% as my risk-free rate, just because they want to use the long-term rate as opposed to their normalized 3.5%. So I'd use 3.9%.
Okay, let's move on to a different topic here. The eCAPM, you're familiar with that, and based on your testimony, you don't support that. Is that correct?
No.
Okay. Subject to check in OCC 1 RRU 396, your response to me was to Google eCAPM when I asked you what it was. Didn't have much luck in finding it. Earlier today, you heard some cross-examination of the company's witness who, based on the Article, I guess I can't pronounce it. It's CHRETIEN and Coggins, which is filed, I guess, in the RRE 169.
Yeah, I'm not,
You're not familiar with that?
no, I mean, the eCAPM, I mean, the term, I believe, is attributed to Roger Moore, you know.
Right.
Dr. Moore has his book. It's a very good book, but Dr. Moore has testified for utilities for 45 years or 50 years. So it has a very slanted view on ROE, but it's a very good book to read. And anyhow, but he created the term eCAPM. I can guarantee you, if you look in the academic world, eCAPM doesn't exist. It's not around. He created the term, you know, and it's used. You see it in utility case. You don't see it in outside of utility cases. You really don't. And it's because it's not been a concept that's been around the academic world.
Okay. There was an attempt to link eCAPM earlier to the FAMA French model.
Yeah.
Do you think that's a reasonable link?
No.
No. And why is that?
Because the farm offense is a bunch of factors, and the only way it's linked is through the high beta, high market value, low market value. There are different factors. One or so of those factors may pick up these eCAPM factors. I don't know.
If I recall correctly, the FAMA French, the factors are not related to the factors or the adjustment in the eCAPM. They're more.
I agree. That's correct.
Can you give me some examples of what would be in the FAMA French?
Well, they have high market to book, low market to book as one of the factors, right? Okay. They have size as one of the factors, even though that kind of disappears over time. You know, they have other factors they attribute to, but you know, high market to book, low market to book is one of their main factors beyond beta, that sort of thing.
Okay. And those are unrelated to what adjustments are made in eCAPM.
Not related to those adjustments.
Thank you. Let's move now to RRU 172, and it's the related to the risk premium bond yield plus methodology presented by the company.
Is that's a UI response, right? 172, it's not me.
Yeah, this is more theoretical. The company itself disagrees with the proposal that this bond yield plus methodology introduces a level of circularity into the analysis, under the explanation that what is meant by circularity is reliance upon allowed jurisdictional's past returns as a predictor of future returns. Would you agree that this, in a sense, does create the cat chasing its own tail?
Well, there's a circularity to it, but I think more importantly, I mean, I specify this. I summarize. I discuss my testimony, summarize it on page 8. But the whole idea is, look, it's circularity in terms of using other commission's decisions to say what's the right ROE, first of all. And I say it's a function of commission behavior, not investor behavior, right? Obviously, you do in a rate case, you're looking at a lot of things: capital structure, rate adjustments, adjustment mechanisms, a lot of other things, plus cost of equity measures, that sort of thing, coming in ROE. Now here, you're just looking to see what other people are doing. So it's really a matter of commission behavior, not investor behavior. Also, when you use it with projected interest rates, I disagree with that, because interest rates, if you're using spot interest rates to estimate your market risk premium, and then you apply it to projected rates, and that's not right. You would have to use projected rates in your estimation to apply it to estimation in identifying your ROE. But I think the other thing is, as I say on page 23 and 24, I cite the Werner and Jarvis article. It says, hey, those past ROEs have been overstated. And so that's another reason why this would overstate a required rate of return, an ROE.
Earlier today, you may have heard this cross-examination of the company's witness, and they indicated they believe that commissions are a proxy for investors, or that investors look to commissions as.
I agree. I think investors look at these definitely, and I think the discussion the company had here is so true. I think Ms. Bulky, but when a big rate decision comes out, I guarantee you, the investment firms and others are writing them up, and they're focusing on all elements of the case, not just the ROE, by the way. So, but obviously, since the ROE is the profit that go to shareholders, that's something they want to look at.
Right. But in this sense, your reason to exclude this methodology is
it's a risk premium. Well, the CAPM is the ultimate risk premium model. This risk premium model is used at all these companies. This is just it's not a model that's been developed. It's just, we're going to estimate it this way. Now, since that's why I call it an alternative risk premium model, because CAPM is a risk premium model, risk-free rate plus a risk premium. This is a different way of looking at what other commissions are doing.
okay. So besides being a gauge of commission behavior and potentially result in this cat chasing its own tail, is there any other rationale to exclude it?
The Warner and Jarvis article that says these things have been overstated for 4 decades. They haven't declined. The real return, the real ROE has been flat for like 4 decades. Yeah, I mean, I think I said pages 23 and 24. I summarized that article and talk about what the issues are.
Okay. Just to clarify your word flat, I think you mean the ROE has just kind of
the real return. Yeah.
But the
inflation adjusted return.
Right. Okay. So the one that is being obtained from rate proceedings is,
right,
would you say essentially sticky up?
Yes. I mean, that's what they said.
Okay. Actually, I have a couple of issues here regarding some topics that were not covered in your testimony. Regarding the ESM earnings sharing mechanism, these are actually more UI questions. Has OCC had the opportunity to consider the proposed 50-50 sharing mechanism as detailed in the application?
I have not been involved in that, so I haven't looked at.
Okay, because the other question was regarding the proposal. There's a adjustment there that future ESM earnings sharing be applied to regulatory assets. I guess you're not the right person to ask here. Could we maybe have a briefing topic if
We'd be happy to confirm now that we can address that in our brief. The question of our position on the proposal for the earnings sharing mechanism proceeds to be put against regulatory assets, correct?
Okay.
Thank you, Attorney Weil.
And this is a similar issue here with the discussion of the ROE adjustment mechanism. There was a response from OCC that the adjustment mechanism would be discussed in its pre-filed testimony of his expert, but I reviewed both Dr. Woolridge's pre-filed testimony and rebuttal to the company. I didn't see that type of analysis done. And if you recall, Dr. Woolridge, there's a discussion from the company that we have essentially an annual ROE tracker tied to treasury rates. Do you recall?
I'm
that?
not familiar, no.
So again, it doesn't seem like you'd be the right person you are the right person, but you didn't follow up here. There's a question in the record called RRU 247, and it's, I believe, went to the OCC. So I propose we either have OCC directly respond to that, or maybe do another brief comment.
Okay, you know what, we're gonna take a 5-minute recess. So if we can, it's just about 2:00 right now. We're gonna take a 5 minutes. So we'll come right back. Thank you.
Yes. So you have a list of what I need, right? Yeah, that's all stuff I can get right
Yeah, no.
hard stuff, right? Yeah. It may be a little more. Yeah. That was great. You know. What's that? Oh, I hate my money. What's that? The CAPM. But everybody. By the way, I don't know. Yeah, because he's been rent. forever. I mean, at least for a year. They don't watch him for he's doctor. He runs the book around. But I just testify that there's no power. But the other witness project board. Oh my God. I mean, we obviously I've gone against it many times over the years. Yeah, I don't even know.
The other doctor there,
Who's that?
he's long retired, right?
Oh, John. Bill. Yeah. I mean, Bill. Bill. Up there. Yeah. Back off the bottom of the page. That was a bear. Okay. That's why first. Well, he testified unopposed at first for like 30 years. So nobody opposed. So first, we're gonna get off this entire thing. And they still use it. Obviously, you're gonna pump up your nose. But all that stuff that we were based on what Bill. Remember, he was UI quick. What's her name?
Yeah.
Linda was crazy. Yeah, way before that, yeah.
It's not very Aver.
Aver, yeah. Dr. Aver. That's where you got cutting off the low numbers. That's where Pure got, we're gonna cut off those low numbers. Bill's the one that convinced you to do that. Yeah. No. No, he had a guy, Adrian McKenzie, who worked for him for 25 years, and Adrian took over the practice. Yeah. But Bill's retired, and Adrian does all that testimony. They work for like all the AEP companies and that sort of thing. I'm going against him in Oklahoma. I just filed in Oklahoma, and he's the witness. What's that? Yeah. That what I forgot. What was the case, Sobe? And I think it was a UI case where.
All right. Thank you for that. We can go back on the record and resume cross, please.
I have nothing further.
Okay.
That was the end.
Okay, thank you. One second here.
I do have just an administrative update regarding Ms. Gerst's question about the updates to 2 exhibits, if this is an appropriate time. We did update. I think the confusion here is that we updated them in 2 different places. So we updated the blue chip exhibit on February 23rd. That was an update to RRU 95. And on the same date, February 23rd, we updated the RRA exhibit, but that was an update to RRU 372. And that might have been an error. That might have been the incorrect number to update, but we've located where those updates are filed.
Okay. I appreciate that. Thank you, Attorney Wheel. Does the EOE have cross for this panel? No. Thank you. Mr. Vice Chairman?
No cross, thank you, Madam Chairman.
Dr. Woolridge, I just have one clarifying question. I understood earlier that I think you listed a couple states who I understood from your response affirmatively require short-term debt in their capital structure, or maybe you just meant that they allow it or do it. Can you clarify that for me, please?
Yeah, I would say they allow it. They permit it. Now, some states explicitly forbid it. For example, I think Massachusetts is one that says no. Despite how much the short-term debt the utility uses. In others, I mean, again, one way to really test it is, does short-term debt finance rate base? And you can go back and look at quarterly rate base numbers versus capitalization numbers to see if you're financing rate base with short-term debt or not. That's another way to look at it.
Okay, that's helpful.
But states, I mean, some states forbid it, but other states are open to it if the evidence suggests it's worthwhile.
Thank you very much.
Look.
I don't have any further questions. So Attorney Wheel, do you need a moment to consider redirect?
No, we have no redirect.
All right, very good. Then Dr. Woolridge, thank you for appearing.
Thank you very much. Thank you.
We'll move into our last panel here. I'm going to call up the Office of Education Outreach and Enforcement panel, and the company will be first up for cross-examination.
I'm gonna have it.
Chairman Gillette, while the EOE panel is getting settled, we have some of the read-ins that we could provide.
Okay.
Now is a good time.
That would be great if you can just start with the letters, please.
We'll do. Let me. All right, Mr. Canavan has the first two. These will be, bear with me a moment. Read-ins double G and double N.
Okay.
Okay, so Mr. Canavan, can you provide read-in double G, please?
Yes, good.
I don't know. I think so.
Yes, good afternoon. Reading double G, the customer service panel was asked about certain EOE interrogatory responses that identified errors in the handling of certain customer calls, and whether the company followed up on those calls with the customers. The answer is yes. The company contacted customers as deemed necessary to resolve any outstanding issues once the calls were made. Once the company was made aware of those calls.
Sorry, I just didn't catch it. If it was deemed necessary, is that what
Yes,
the
my
answer was?
understanding is that these calls, when they were filed in that docket, the company was made aware that certain customers, the calls were being challenged by the OCC. Some of those customer complaints were actually resolved because this was many months after the actual calls happened.
Okay.
So the company reviewed its database with regard to those calls and those customers. And if there were outstanding issues, those customers were contacted. If those customers' issues were fully resolved by the time the company reviewed those calls with the OCC, there was no need to follow up with those customers.
Okay, thank you.
Okay, thank you, Mr. Canavan. We also have several of the read-ins that Ms. Skuris asked from Ms.
Sorry,
Buckley.
he has got an
I'm
N,
sorry.
right?
Oh, I'm sorry. Yeah, sorry.
Read-in and the customer service panel was asked about how the late payment charge of 1.25% per month was determined. The response is the company's terms and conditions provide as follows. Bills for residential and non-residential customers not fully paid within 28 days after the statement date shall be subject to interest on the unpaid balance at the rate of 1.25% per month from the statement date of the bill to the date payment is received at the company's offices or at authorized collection agencies. The payment charges accrues on overdue balances. UI does not apply the interest calculation on previously assessed late payment charges. The 1.25% interest rate was set by PURA in decision dated October 1, 1998, docket number 920605. And that will conclude that read-in.
Okay.
Thank you.
Thank you. And now we do have several of the read-ins that Ms. Skuris requested from Ms. Bulkley. Ms. Bulkley, I'm going to ask you only the read-ins at this point. I know we have some of the information on the late files, but let's start with read-in TT, which related to Otter Tail Power. Can you and its plastic segment? Can you please provide that?
Sure. So in my earlier testimony this morning, I misspoke and didn't recall the correct issue with the plastics division of Otter Tail Power, but that was actually described in footnote 33 in my direct testimony. Otter Tail Power had a one-year anomalous financial result, which caused the operating income from regulated electric operations to fall below 70%, which was my screening threshold. On page 4 of the Otter Tail 2021 10K, the company stated our 2021 earnings mix was impacted by significantly higher earnings in our plastics segment as unique supply and demand conditions during the year in the PVC pipe industry led to earnings levels not previously experienced. We expect our earnings mix to return back to our target 70% from the electric segment, 30% from manufacturing and plastics. Based on those conditions, we included Otter Tail meeting the screening criteria.
Okay, thank you. That concludes that late file. And then read in U relating to thresholds and screening criteria.
Yes, so the full list of screening criteria that I relied on were provided in response to RRU 0080 attachment 8. So that includes all of the screening for all of the value line companies. Specifically, Ms. Skuris asked for the revenue screening for CMS, Dominion, Con Ed, and Southern. For CMS, the total electric revenue to total revenue would be 67.59%. For Dominion, 81.97%. Con Ed, 69.93%. Southern, 72.95%.
Okay, thank you. And then read in VV relating to the Dominion transaction closing date.
Yes, the Dominion transaction closing date was December 31st, 2021.
Okay, thank you. And then lastly, for now, we have read in WW relating to Hawaii Electric and why that was screened out on your criteria.
Sure. So Hawaii Electric was screened out based on information in the company's 10K related to its unique risk factors. In the company's Form 10K, they note that the company is subject to risks associated with geographic concentration of its business and current lack of interconnections that could result in service interruptions at the utilities or higher default rates on loans held by the American Savings Bank, which is a subsidiary of Hawaiian Electric. Increased risk of service interruptions resulting from HE's geographic location that could result in revenue loss, and increased risks is a risk unique to HE and would not apply to utilities located on the U.S. mainland. Furthermore, HE's unregulated operations, which represent 33% of the company's operating income in 2021, are concentrated in the banking sector through the ownership of American Savings Bank. ASP also only operates on Hawaii. Thus, all the company's consumer and commercial loans are to customers in Hawaii. If Hawaii were to face adverse economic or political events, ASP would face severe financial effects given the company's geographic concentration in Hawaii. As a result of those risk factors identified by the company themselves, I excluded them from the proxy group.
Okay, thank you. Actually, and I do have one last one, which is read in XX in the Montana use of the Montana eCAPM. Do we have that one?
Yes, I do. Yes, I've confirmed, and I have a docket and an order number that Montana does specifically include the calculation of the eCAPM and its final result. This would be docket number D 2017.9.80, order number 7575C, dated September 26, 2018.
Okay, thank you.
Sure.
So Chair, that's what we have for read-ins at this time.
I think that's all of them.
I think, yeah, I think
Okay.
I got out of sync with you. I think I didn't catch what late file, was there a late file 141? Because the last one I had to the company was late file 140, unless I missed in my in the transition time.
No, you are right. I wrote refer to RRU 332, which I think was an incomplete thought.
Okay.
So I need to take a step back. Attorney Wheel, that means that I gave you the wrong numbers for your two late files. Your two late files are 141 and 142. So I apologize. Thank you, Attorney Venora.
Thank you.
Okay. With that, would you introduce your witness, please?
Thank you. Mr. Rothschild, can you please state your name and professional title for the record?
My name is Aaron Rothschild. I'm president of Rothschild Financial Consulting.
Very good. Mr. Rothschild, can you please raise your right hand? I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury.
I do.
Thank you.
Okay. Did you prepare or assist in preparing any pre-filed testimonies and interrogatory responses in this matter?
Yes.
Do you have any additions or modifications to either of these?
Yes, I do.
Can you please explain those?
First, I have an update to chart 100 with and without option implied betas. Second, I have an update to chart 101 to include data through January 2022. Finally, I have updates to chart 104.
And we can file all of those as a supplement to our pre-filed testimony.
Okay, thank you.
Do you adopt those interrogatories and responses with the changes that you made?
Yes.
The witness is ready for cross. Thank you.
I'm sorry. Thank you. Attorney Hum.
Thank you, Madam Chair. Good afternoon, Mr. Rothschild.
Good afternoon.
My name is Robert Hum. I represent the United Illuminating Company in this case. So the goal in setting the ROE in this case is to reflect the investor required return on equity, correct?
Yes.
And one of your concerns is that the ROE results should represent investors' medium to long-term return requirements, correct?
Yes.
And you consider long-term as a period of 12 months or more, correct?
It would depend on the context. Are you referring to a specific place in my testimony or just asking me in general?
Asking you in general, but I can point to a specific place in your testimony. And what I would point to, Mr. Rothschild, is the use of the term, using long-term in the term of leaps. You define that as being, I believe, a 12-year period. And I can refer to the testimony if you'd like.
The leaps go out to as far as 61 months. So just a little over 5 years.
So I will just refer to your testimony only for purposes of just referring to long-term.
Yeah.
On page 12 of your direct testimony at footnote 6, in describing what leaps are, they're defined as these are stock option contracts with expiration periods of 12 months or more, correct?
Yes, and then, but to be clear, the leaps do go out to 61 months in this case. Yeah.
Okay. So when I ask the question of you consider long-term as a period of 12 months or more, that would be accurate, correct?
Well, the thing is, until recently, the furthest out options that were available on the S&P 500 was 36 months, which was frustrating because I wanted to see investor expectations out as far as possible. They just weren't available. But it's been about a year now that they go out to 61 months. So I think that's helpful. It's quite a bit further horizon than I was able to look at before in terms of defining exactly what long-term is. It's hard exactly to say. I do provide data from a number of sources. Was it JP Morgan and surveys that involve pension funds, and a lot of their surveys look asking these funds their expectations over 10 and 20 years. So I do consider those different timeframes, but with stock options, we can only go out about 5 years at this time.
Would you agree that it's fair to say that the ROE is intended to reflect the investor required return on equity over the next several years?
That really depends. I mean, it depends on the time frame of investors who are purchasing stocks. It's hard to tell exactly when different investors plan to have different investment horizons. I think it really depends, but that's why I provided the term structure analysis to see what investors' required returns are over different horizons, which would include over the next few years. Yep.
Now, when establishing a proxy group, is it necessary that the proxy group has comparable risk to the utility it is measuring against?
It's helpful if they're as comparable as possible. I just want to be clear that I think you're referring to the LEAPS group. I didn't use that to calculate my cost of equity recommendation specifically.
And I guess to clarify, my question wasn't limited to the LEAPS group.
Okay.
Does that change any of your answer?
It's I don't think my views on this are anything unique, but it's that we want a proxy group that's as close as possible, yes, to the risk level of the utility that's in the proceeding. In this case, UI, yes.
Now, you rely on a proxy group of companies for your DCF and CAPM analysis, correct?
Yes.
And that's the RFC Electric proxy group, correct?
Yes.
And the intent of a proxy group, as we discussed a minute ago, but I just want to narrow since we're not just talking about LEAPS, but the intent of a proxy group is to reflect the risks that are comparable to UI, correct?
Yes.
And you believe that the RFC Electric proxy group companies are representative of the risks faced by UI, correct?
Yes, I think they're reasonable. It's the same proxy group used by Ms. Bulkley, and I believe it's a reasonable proxy group to use, yes.
And because UI is an electric distribution company, starting with the universe of electric utilities would be the place to begin to establish a proxy group for UI, correct?
That's a reasonable starting point, yes.
So gas companies are not included in the RFC Electric proxy group because they're not comparable, correct?
In some context, it can be helpful to look at utilities in other industries, but in this case, there's no need. We have plenty of electric companies. Yeah.
Would you agree gas companies have a different risk profile than electric distribution companies?
Yeah, they do slightly. In terms of the cost of equity results that I'm getting for gas are a little bit different than electric, yeah.
And water companies are also not included in the RFC Electric proxy group because they also don't have a comparable risk, correct?
Yes, it's more appropriate to use electric when you can, in this case, yes.
Right, and that's important because if a proxy group is not risk comparable to UI, then the results of the analyses would not be relatable to UI, correct?
I believe you're talking about in the context of the RFC Electric group now?
Correct, and in general in developing a proxy group.
What I'm answering specifically is in the context of the RFC proxy group and also Ms. Bulkley's group to use in the CAPM and DCF. I would agree completely, yes.
And as we discussed a few moments ago, you relied on a second proxy group called the RFC Electric LEAPS proxy group, correct?
Yes, I use that for the term structure analysis.
And LEAPS stands for Long-Term Equity Anticipation Securities, correct?
That's correct.
And that proxy group included 12 companies, correct?
That's right.
And all of the companies in the RFC Electric LEAPS proxy group are electric companies with options contracts, correct?
Sorry, you're referring to the companies in my LEAPS group?
Correct.
Yes, they're all the companies that are covered by electric utility companies covered by Value Line that have LEAPS contracts traded. Yes.
And so Ameren from the RFC Electric proxy group is not in the LEAPS proxy group, correct?
That's right.
And Elite from the RFC Electric proxy group is not in the LEAPS proxy group, correct?
Oh, sorry, which company?
Elite, ALLETE.
I believe so. Yes.
And Avista from the RFC Electric proxy group is not in the LEAPS proxy group, correct?
Sorry, let me go to I trust that that's correct, but let me get there to make sure. Okay, can you ask that last one again, the last company?
Sure, and I'll ask the same question for Avista, Entergy, and Evergy.
That they're not in that they're in the LEAPS group, but not in the,
That they're in the RFC
Proxy.
electric proxy group, but they are not in the LEAPS proxy group.
Yes, that's correct.
And the same would apply for the following companies as being companies that are in the RFC electric proxy group, but are not in the LEAPS proxy group. And that would be Ida Corp, Alliant Energy, Northwestern, OGE Energy Corp, Ottertail Corp, Portland Energy, and Excel Energy, correct?
That's right.
Now, if you can please turn to your surrebuttal testimony at page 11.
Yeah.
And on lines 8 through 9, it indicates that you use the RFC electric LEAPS proxy group to provide PURA with, quote, a broader set of model results in support of your recommendation and to consider the cost of equity term structure, correct?
This is page 11, lines broader.
And just for reference of this question and for future questions, when I reference the page numbers in the testimony, I'm referring to the actual page numbers of the testimony on the bottom of the page.
Okay, yes. Yes, I see that.
And was that a correct statement, or do you want me to read that again?
That's correct.
Now, you did not conduct a DCF and CAPM analysis using the RFC electric LEAPS proxy group, correct?
I did. The CAPM was used to calculate the term structure of the cost of equity, but I didn't do a DCF on that group.
And the data for the LEAPS analysis was not available for the majority of the RFP electric proxy group, correct?
Yes. Only 12 companies have LEAPS, yeah.
Now, if you can please refer to your direct testimony at page 5. And specifically on lines 6 through 7, there's where you quote Federal Power Commission versus Hope Natural Gas Company, 320 US 591 at 603 from 1944, for the principle that, quote, the return to the equity owner should be commensurate with risks on investments and other enterprises having corresponding risks, correct?
Yes.
And turning forward to pages 21 to 22 of your direct testimony.
There, sir.
As support for your recommendation of a return on equity of 8.68%, you state on page 21, line 14, below is a sample of recent authorized ROEs for utilities in other jurisdictions. I picked these as examples of authorized ROEs that I believe are most reasonable, correct?
Yes.
And then the first 3 bullets that are listed on page 22 are Kiowa Island Utility Incorporated, Palmetto Wastewater Reclamation Incorporated, and Blue Granite Water Company, correct?
Yes.
And those three companies are a water company, wastewater company, and another water company, respectively, correct?
That's right.
And none of those companies are in your RFC electric proxy group, correct?
That's correct. I included them because those cases involved a consideration of my methodology.
In the last two bullets on that page 22, which is Ameren, Illinois, and ComEd, those are both located in Illinois, correct?
That's right.
And the authorized returns for Ameren, Illinois, and ComEd are determined annually as part of each company's formula rate plan, correct?
That's correct.
Now, out of the 5 operating companies that you list in the bullets on page 22, which you state are examples of authorized ROEs that you believe are most reasonable, none of those specific operating companies are in the RFC proxy group, correct?
That's right. I just included them to make sure that Pure understands that that when authorized ROEs have been awarded in this range, in consideration of the methodology and tested through the procedure, the commissions have made those decisions to adopt those ROEs. And also when we've seen ROEs even as low as 7.36, we've seen companies would be able to raise capital. None of these companies are a perfect comparison, but I think they're helpful in terms of the broader picture of ROEs that are reasonable for regulated utilities to be awarded.
Now, you believe that interest rates will be decreasing over time, correct?
I don't know what interest rates will do over time. I do know that the Federal Reserve Bank of Atlanta has used options, as I do, to show that investors do expect the federal funds rate to be decreasing over time. And also an analysis just of market yields shows that investors do expect, the analysis I showed was that investors at the time expected the 10-year to remain elevated, actually in the long term. So in that case, investors showed the 10-year would remain elevated, but the federal funds rate would decline.
You believe that the ROE in the DCF model may overstate the COE, correct?
The accounting, it reminds me of what we were discussing earlier. In terms of the ROE, you're referring to the return on equity or the accounting return?
Correct, the return on equity?
Yes, we have market to book ratios of electric utility companies are about 2. So the return to investors is significantly lower than the accounting return.
And you apply the COE term structure analysis, correct?
I apply it. I'm not sure I understand.
Sure. I think that was my question. You apply the COE term structure analysis.
I provided that in my testimony, and I considered it in my recommendation. Yes.
Your COE model results produce a high end of 9.50% and a low end of 8.41%, correct?
Can you refer to the page number where you see it?
Yep, one moment. If you can turn to your direct testimony at page 91. On lines 12 and 13, you state in the middle of that line, I conclude that the cost of equity allowed for UI should be between 8.41% to 9.50%.
That's correct.
And the mathematical midpoint of that range is 8.95 or rounded up to 8.96%, correct?
That's right.
Now, on page 13 of your direct testimony, you state, beginning on line 4, that stock option data show that investors expect COE for the overall market and electric utility companies to decline in the future, correct?
Yes.
And you continue on that page. Therefore, I recommend an authorized ROE of 8.68%, which is halfway between the midpoint, parentheses 8.95%, and the low end, parentheses 8.41% of my model results, correct?
That's right.
Now you agree that stock options are speculative, correct?
So is equity.
So it is the answer a yes, though, to my question?
I just want to make sure to say that they're also the equity, underlying equity is speculative as well. Actually, I'd like to make sure I understand what you mean by speculative.
Sure. So you're familiar with the publication Forbes, correct?
Yes.
Would you agree, subject to check, that in an article entitled "What Are Options?" published on January 25th of 2022 on the Forbes.com website by its editor Benjamin Curry and also by Brian O'Connell, the authors state options trading is a highly speculative exercise?
This is a pretty large conversation about the difference between stock options and the underlying. I'll just say really quickly that they can't diverge too much because there would be an arbitrage opportunity. If stock options had no relation to the underlying, I think traders would be able to make a lot of money quickly. So they are highly related. So yes, there are a lot of people, especially over recent years, who are going into stock options as kind of gambling, if you will. So I think they may be referring to some of those things. You could basically get a high leverage and you can have kind of lottery tickets by buying stock options that are way out of the money. So I think that's what they're referring to. But I think that they're very helpful here because unless we're assuming that there's a tremendous trading opportunity and there is no relation between options and the underlying, they are valuable resources to understand investor expectations.
Now, when did you begin using the COE term structure analysis that's in your testimony in this case?
I've always, through the years, I don't remember the first time I've considered it. Every time when I prepare a testimony, I consider run many tests and consider different numbers. So I have been watching this and considering it for some time. I believe that I've mentioned it in other cases. This is the first time that I've used it in this way because it was surprising to see a declining term structure. As I understand, historically, it's usually increasing. So the fact that it was a decreasing term structure, I felt that it would be important for Pure to consider that in their analysis. And what's been interesting is, in this case, investors were correct because the cost of equity has been declining in line with what investors had expected, as indicated by the term structure.
Now, would you agree that your COE estimates are based on 3 months of market data?
I consider 3 months, and I also consider a spot for the most recent results as well.
And the reason that you consider the 3 months is to address any anomalies that might occur on any given day within the market, correct?
Yes, I think capital markets are very turbulent. They can move around quite a bit. We don't want to be kind of fooled by any kind of noise or randomness. So I think it's important to consider both. In some cases, the spot would mean almost everything, and the historical shouldn't even be considered. For example, when I use stock options to evaluate the risk of PG&E, you wouldn't consider 3 months average right after the campfire came out, and investors were understanding they were going to be in big trouble. It was a fundamentally different company within 1 day, so you probably wouldn't give any weight to a 3-month average. But in this case, I think it's valuable to look at both.
Now, please turn to your direct testimony at page 16. One moment. I'm sorry, one moment, Mr. Rothschild. I might have brought you to the wrong page.
No problem.
Page 15. Thank you. So lines 11 through 13 on page 15 states that your cost of equity recommendation of 8.68%, parentheses 8.41% to 9.50% for UI is in the middle to upper part of the range of the expectations published by major banks and brokerage houses, parentheses 6.6% to 9.0%, shown in table 4 below, correct?
Yes.
And referring to that table 4 on page 15, the return expectations stated here are not published by major banks and brokerage houses specifically for utility companies, correct?
These are for the overall market, which would include some utility companies, but it's for the overall market.
So for the overall broader market, might include utility companies, but not specific to utility companies, correct?
Yes, this would really be in line with the S&P 500. Yeah.
And again, on this page 15 that we're on, lines 11 and 12 state that your ROE recommendation is in the middle to upper part of the range, correct?
Yes.
Do you expect utility returns to be above broad market expectations?
Yeah, I don't know what the actual returns would be, but I would be surprised if investors expected to earn a higher return on utilities than the overall market.
Now, please turn to your surrebuttal testimony at page 4. Beginning on line 12, you state, Ms. Bulkley's non-market based perspective is dangerous because these experts do not provide the capital UI needs to provide safe and reliable service, correct?
Yes.
Have you reviewed Dr. Woolridge's testimony in this proceeding?
I have some, yes.
Are you aware from your review that Dr. Woolridge relies on what he refers to as Wall Street analysts' EPS growth rate estimates for his DCF analysis?
It's important, though, that he also, as I understand it, considers a sustainable growth methodology as well. So it's makes it much more reliable when he takes those numbers and considers what would be reasonable for as a sustainable growth over the long term. But yes, he uses that, and I use Value Line's future expected return on book equity as well. I think that was why I developed this whole method of using stock options, is so we could get away from that as much as possible. But I think we have to use the information we have available, and some of those are whether Value Line or Zacks or others, but we have to be very careful with using them because not only for mathematical reasons, they may not be appropriate at all for a DCF model, but also because they can be upwardly biased. I've spoken with analysts directly, including at S&P Global, and they said, be careful with using these. These are often sell-side analysts. They're known to be too high. So we have to be very careful with using those analysts.
Now, are you aware of any other expert that files cost of capital testimony who relies on a COE term structure analysis, such as what you've provided in this proceeding?
No, but I think it should be investigated more. I think it's very helpful. I was happy to include that. There's a lot of work to come up with that, and I think it's something that could be helpful for commissioners, and I would love to see how others would go about doing that, and to see if it could be improved in different ways. So I hope we see more of that.
Are you aware of any regulatory commissions that has adopted this adjustment to the traditional ROE estimation model?
Any commissions that have considered a term structure analysis?
Correct.
No, I don't.
Now, turning to page 58 of your direct testimony. On lines 7 to 8, you state that you based the value of the future expected return on equity -R on the average return on book equity expected by value line, adjusted in consideration of recent returns, correct?
That's right.
Now, are these forecasts that you're referring to?
Yes, but it's important. These are forecasts of accounting returns.
And for what period is the average return on book equity expected by value line?
It's over a 4-year period.
And is this a market-derived estimate or an analyst estimate?
This is analyst.
And specifically, this is provided by a value line analyst, correct?
Yes.
And for each proxy company, this estimate of the expected return on book equity is provided by a single value line analyst, correct?
Yes. It's important that I also do consider Zacks in my DCF and option implied growth as well. Yep. I wouldn't want to just rely only on value line for anything.
Sure, and I'm just talking about what value line is providing in terms of their analysis. So by being provided by a single value line analyst, this is not considered a consensus estimate, correct?
Yeah, that's why I rely on many different sources, including options, which would include looking at what millions of investors consider. And I also look at Zacks as well.
Now, please turn to page 60 of your testimony, your direct testimony.
I'm there.
On line 18, you state, my results are not as influenced by overly optimistic analysts' forecast as would have been the case had I merely used analysts' 5-year earnings growth rate forecasts as a proxy for long-term growth, correct?
Yes.
Does your characterization of overly optimistic analyst forecasts apply to Value Line's forecast of earnings growth rates?
Well, the reason why I think there's some difference there is again, I'm skeptical of all the data that I received, so I check. So I would not just accept Value Line completely. So it is a concern that it could be biasing my numbers up a little bit. In this area, I'm not as concerned, but I think it should be considered. I think that's a good point.
And does your characterization of overly optimistic analyst forecasts apply to Value Line's forecast on dividend growth rates?
Again, I think that's a good point to be concerned. Yeah.
And same question, does your characterization of overly optimistic analyst forecasts apply to Value Line's forecasts on the expected return on book equity?
Again, I think it's a good point to be concerned about that.
Now, what is the proxy group average return on book equity that you are applying in your DCF analysis?
Excuse me, the proxy group?
The proxy group average return on book equity that you are applying to your DCF analysis.
Excuse me one sec.
No problem. And Mr. Rothschild, while you're looking it up, perhaps I can help. Is it 10.10% that's reflected on Exhibit ALR3, page 1?
Yes.
Do investors compare the expected return on book equity in other enterprises having corresponding risks when making investment decisions?
No, I wouldn't think so. I mean, if you look at the return on book equity by the companies in the S&P 500, for example, you're going to see them from 4% to 80% or 120%. So I don't think any investor would say, oh, I think I can get 120% return by buying this company and only 7% by buying another. You'd have to look at the stock price so I think an investor who did that would clearly wouldn't know what they were doing.
Now, please turn to your direct testimony at page 65, lines 14 through 15. And there you state, my spot and weighted average long-term risk-free rates are 4.22% and 3.84% respectively, correct?
Yes.
And did you rely on any expectations of interest rates in selecting your risk-free rate?
Yes.
Now, please turn to page 107 of your direct testimony.
I just want to be clear when you say expectations, I'm relying on investor expectations indicated by market data. You didn't rely on blue chip or something. At 107?
Sure. And actually, you raise an interesting point, though, with what you just said. So if we can return back to page 58 of your direct testimony.
Yes.
And this is where you state that you base the value of future expected return on equity -R on the average return on book equity expected by value line adjusted in consideration of recent returns, correct?
Yes.
And value line considers expected interest rates in developing their projections, correct?
I haven't asked, I've asked them a lot of questions. I haven't asked them that one.
So is that something you're aware of one way or another?
I'm not aware if they review, if they have a perspective like I do, that we should use investors' expected interest rates based on market data, or whether they use economists' forecasts that I, of course, I strongly disagree with using. I don't know. I will ask them.
All right, now we can turn to page 107, please.
Hello?
And on line 19, you state, I calculate historical betas following the methodology used by Value Line with some modifications, correct?
Yes.
In Value Line, we discussed a bit, but that's a resource that's widely available to investors and commonly used by investors, correct?
Yes, I really like this topic. Yeah.
Okay, good.
Yeah.
Value Line is also widely used in regulatory proceedings, correct?
Yes.
And Value Line reports beta coefficients, correct?
Yes.
And you've calculated historical beta coefficients in a manner generally consistent with Value Line, correct?
With some modifications, yeah.
And you've also calculated forward-looking beta coefficients or option implied betas, correct?
Yes.
Does Value Line report any option implied betas?
Not at this time. We have been getting interest from data providers to do this, but they don't yet. Yeah.
And does Value Line report forward betas of any kind?
Not that I'm aware of yet.
And are you aware, I don't know if you heard my questioning to Dr. Woolridge, but are you aware that Yahoo Finance, Bloomberg, Google Finance, Reuters, Morningstar, Capital IQ, MarketWatch, or CompuStat all report beta coefficients, correct?
They don't at this time.
You're referring to option implied betas or forward betas.
Or
correct?
any type of forward betas. Actually, that's another interesting one. I would say that value line actually does, to some degree, provide forward-looking betas in the sense that they use the Bloom adjustment. It's a paper from 1971 that has to be, I think, potentially investigated again. But that is an assumption of a reversion to the mean for these historical betas, and the purpose of that was to have them be forward-looking.
And is that something that they use today?
Yes.
Now, you've personally developed the software programs for developing the option implied betas, correct?
Yes, that took longer than I thought. Yeah.
Are these software programs available to the public?
Not yet.
Have the software programs for developing the option implied betas been peer reviewed or subject to any kind of quality review or certification process?
They've been evaluated by many commissions and also the South Carolina Supreme Court has evaluated these, but yeah.
Are the software programs proprietary?
We share all of the output so that everything could be reproduced. So we shared in proceedings, including this one, all of our supporting data.
And let me backtrack for a moment just from something you said to my prior question about quality reviews or peer reviews or certification. Have there been any quality reviews or certifications from a market analyst, professional organization, or other publication?
To some degree, I speak with different quants and traders about the methodology, and we've discussed it. So it has been evaluated in that context for many hours of conversations and discussions that we've had.
Now, going back to the software program, have you developed, or I should say you have developed a software program for the purpose of calculating the beta coefficients, correct?
Yes. And that's using the methodologies by the Chicago Boards of Options Exchange. And we have tested that that the results are nearly identical.
And if you can please turn to page 114 of your direct testimony.
Yes.
At footnote 102, you cite Peter Christofferson, Chris Jacobs, and Gregory Vainberg for forward-looking betas at page 16 from April 25th, 2008.
Yes.
Now, in your study period, were any of the proxy companies used in your analysis undergoing large mergers or acquisitions?
No.
Were any of the proxy companies used in your analysis reorganized and emerging from Chapter 11?
No.
Were any of the proxy companies used in your analysis undertaking initial public offerings?
No.
Were any proxy companies used in your analysis undertaking large-scale expansions?
Nothing I'm aware of.
And were any of the proxy companies used in your analysis making major changes in the composition of debt and equity?
It's possible, but not that I'm aware of.
Now, on page 24 of the Christofferson, Jacobs, and Vainberg publication that you cite in footnote 102, it states that these are the circumstances under which the option implied beta method could be applied, correct?
I'd like to respond with the analogy I was trying to discuss before about the thermometer. I said thermostat by accident earlier, but if we say that a thermometer is able to measure rapid change, that's just something that's valuable because in this context of measuring betas, they're historical, so they cannot measure rapid change. So we've been dealing with, in that analogy of temperature, we've been dealing with backward-looking results, like a thermostat that's backward looking, and a thermometer. But the important thing here is that if a thermometer can measure change, it can also measure when there is no change. So I've heard that discussion before, but I don't agree with that potential criticism at all.
So let me regroup on that question, because I think I asked a different question than what you answered.
Okay.
So on page 24 of the publication that you cite on footnote 102 of your direct testimony, it states that undergoing large mergers or acquisitions, reorganization and emergence from Chapter 11, undertaking IPOs, undertaking large-scale expansions, and making major changes in the composition of debt and equity are the circumstances under which the option implied beta method could be applied, correct?
Again, that's particularly when they say it's valuable, and I found that to be true, as I'd mentioned when we measured PG&E, when the campfire had been determined to be an issue by investors. You could see immediately the adjustment where historical betas took time to adjust. But we've of course gone beyond this paper that was done in 2008 considerably. And the important thing to notice is that after COVID, that was certainly a major event. You saw that the option implied betas declined. It was about a month or two after that peak of turmoil caused by COVID in March 2020. It declined, and following that, right after that, where historical betas followed, the 6 month went down, the 1 year, the 1 1/4. That was I think a powerful example that it measured the return to normalcy there, and that didn't have to do with mergers or IPOs or anything. And if you just look at that, and even if you're not a fan of stock options, you can see that these stock options were indicating before historical betas were able to do it, that the risk level had changed. Investors knew that things were different a month or two later, but way before these historical betas could pick that up. And I don't think this paper at that time had done that kind of analysis. Yeah.
Okay, but just to clarify the question, because I still don't know if I heard the answer even at the beginning. The publication does state that those things that I listed are the circumstances under which the option implied beta method could be applied, correct? Is that a correct statement?
Yeah, that is one situation when it could be applied, yes.
And that publication doesn't include any other examples, correct?
I'd have to review the paper. I think they did a number of different studies on using that, including, in general, they tested many different ways in which various combinations of option implied betas and historical betas, which ones were better predictors of future historical betas. And I'm almost sure it was not in every one of those cases that it involved mergers or IPOs. So I would say they examined many different situations and not just IPOs and mergers.
Now, also at page 24 of that same publication that you cite to in your footnote 102, it states that this method is not conducive to a cost of capital analysis, correct?
Yes, well, one of the reasons they discussed why that would be problematic is because you should be considering leaps, and they hadn't done that. But I have. You know, it'd be interesting to speak to those authors at this time and say, well, we've been considering leaps.
So in your direct testimony at pages 68 and 75, and that's referring to footnotes 50 and 53.
Page 68 of my direct?
Correct.
Okay, I'm on page 68.
Right. I think page 68 has footnote 50, and then page 75 has footnote 53. And in those footnotes, you rely on Bo Young Chang and Peter Christofferson and Chris Jacobs and Gregory Vainberg from 2011, Option Implied Measures of Equity Risk, Review of Finance, Volume 16, pages 385 to 428, correct?
That's right.
And in this article, the authors observed that the performance of the option implied betas may be improved by adjusting these betas using a predetermined rule or by smoothing betas and or moments using information extracted from option prices on other days, correct?
Yes, that's why I don't just use the spot, but I consider option prices on other days.
And please turn to your direct testimony at page 73.
And
on lines 4 through 5, you state, I start my process with publicly available trading information for all the options for a given security, company, or index for a complete trading day, correct?
That's right.
Did you rely on options contracts for a single trading day in calculating the option implied betas?
As I explained, I consider option data from multiple days in terms of determining the option implied betas that I use in my CAPM. This is how I start the process here. Yeah.
So now let's go back to that page 114 at footnote 102.
Yes.
And again, this is the Christofferson, Jacobs, and Vainberg forward-looking betas from 2008 at page 24. Withdrawn. This cites the page 16, but I'm referring to page 24 that we were discussing earlier in your testimony today.
Okay.
Now, for the purpose of calculating option implied betas, you've relied primarily on options contracts with an expiration date of 180 days in the future, correct?
Yes, for the same reasons that the paper does. There's many more option contracts available, but of course, as we've been discussing, I also consider in my term structure analysis, I consider the leaps that they had suggested would be helpful to consider.
And subject to check, would you agree that on the page 24 that we've referenced in that publication, the authors observed that, quote, the main focus in this paper has been on forecasting 180-day ex post betas, which are relevant for certain applications such as abnormal returns. For other applications such as cost of capital calculations, longer horizon betas may be needed. We plan to investigate the performance of option implied betas in this context by using leaps, as well as option contracts with longer maturities trading on non-US markets. Did I read that correctly?
Yes, that's why I've worked hard to include leaps in this analysis.
Do you consider utility returns to be abnormal returns?
There could be times when they have abnormal returns or abnormal behavior. All stocks can. Yeah.
Is that something that you specifically considered in this case?
I think we were discussing that before. I think this methodology can measure what it's really good at doing is giving us a current understanding of what investors expect, and that would be if they expect something abnormal, if they expect something to be normal. Again, like I said, over COVID, it seemed to be a powerful tool for measuring when investors expected the markets were coming back to normal.
Now, referring to your direct testimony at page 76.
Yes.
Lines 7 through 8 states that, and it's referring to the RFC Electric Proxy Group, that you chose to use 6 months as the time horizon of your option implied beta, correct?
That's right.
Now, sorry to flip flop on the page turning, but in the footnote 102 on page 114 that cites to the forward-looking betas at page 16, is it accurate that on that page 16, the authors observe that, quote, when does the forward-looking beta perform poorly? While we do not have an all-encompassing explanation, it is noteworthy that the forward-looking beta does poorly in a few cases where the average realized beta is either very low or very high. For example, the average realized beta estimates for Johnson & Johnson, J&J, and Altria, MO, and Procter & Gamble, PG, are 0.676, 0.544, and 0.612 respectively, and the forward-looking betas are negatively correlated with the realized betas in these cases. Did I read that correctly?
Yes.
Have you performed any sensitivities to your sustainable growth, constant growth DCF model?
Actually, can I respond to that about the performance of option implied betas?
I don't think there's a question pending on it. I've now asked about sensitivities on the sustainable growth, constant growth DCF model. And that's, have you performed any such sensitivities?
Can you repeat that? Any sensitivities?
Sure. I'll restate the question. Have you performed any sensitivities to your sustainable growth, constant growth DCF model?
What do you mean by sensitivities?
Sure. So for example, have you looked at the isolated effects of an increase or a decrease in stock prices of your proxy companies?
I have done some tests on that. My primary way that I at this point test the results, the reasonableness, are to use the option applied growth. But I have looked at changes in stock prices. Yeah.
And that's something that you did for your proxy companies in this case?
I didn't do a specific test on that here. I know we discussed that in the Aquarian case, running different tests. But here, I used as my test was looking at the option implied growth.
Mr. Rothschild, are you looking into something or are you waiting for the next question? I'm sorry.
Yeah, give me 1 second.
Yeah.
Thanks. Just for example, on table, it's page 12, table 2 of my direct testimony. My constant growth, the sustainable growth method, provides a 7.8 to 8.14% percent result, and my constant growth using option applied growth is between 8.66 and 958. So in that case, it's one other piece of information I consider.
Holding all other variables constant, have you looked at dividends?
I use, how about, have I looked at changes in dividends? All else equal? Leaving all else equal?
Correct.
No, I don't believe I've done that here, no.
Have you looked at book value per share?
I include book value per share in my analysis.
How about holding all other variables constant, have you looked at book value per share?
No.
Holding all other variables constant, have you looked at expected return on equity?
No, I haven't.
And would you agree that changing the stock price would have an effect on dividend yields, correct?
Yes.
And changing the stock price would have an effect on market to book ratio, correct?
Yes, it should, yeah.
And changing the stock price would have an effect on retention rate, correct?
It should. I would, of course, have to see. I would say in general, I guess you're saying all else equal. There's one thing with the sustainable growth method that I use. It has that SV term that we're talking earlier, which is that growth from the sale of new common stock. And one of the interesting things now with the market to book ratios of utilities being so high, issuing new common stock becomes really a source of growth. And so because I think it's an indicator that the authorized ROEs are above the cost of equity, you can have in a sustainable growth method where as you make certain adjustments, you don't exactly get those results that you would expect in that way, because the change in this decreasing the stock price can also decrease that growth impact from the sale of new common stock. So I say all else equal those pieces, but I have to make that important point about the sustainable growth method that I implement is that SV term, which is the growth from the sale of new common stock, can make some of those adjustments not exactly as you would expect.
So last question on this, holding all other variables constant, changing stock price would have an effect on anticipated growth, correct?
The anticipated growth from the sale of new common stock?
Correct.
Yes, that is something that's very interesting. If you have a very high stock price, then when you issue new common stock, it's going to be the opposite really of what's the term? The opposite of dilution. And you're going to get that kind of growth in that way. Yeah.
Okay. Thank you for your time, Mr. Rothschild. I have no further questions.
Thank you.
That's it. Okay. We are going to take a 5-minute break. And when we return, we will resume with cross for Mr. Rothschild. Okay.
Yeah. Before we started.
Especially if
Right.
So we think they exclude.
That means that seeing and four of them, but here. studying C and people, this one is the. This one is the bank problem. I didn't get any response on those.
Okay, so we don't think they answered them.
Right, I didn't, I'm not sure if I heard. Yeah, okay, this is the.
Oh, I'm sorry. Yeah.
These are set to reading ADU.
Yeah. Still plenty of daylight today.
Percentages? Yeah, I want the companies that she read in.
She had Con
Yep.
Southern.
Okay, I'll give you the percentages too.
This was 69.93. Southern was 72.95. The Midland was 81.97.
See ya. See.
Oh, yeah, for, that was 67.5.
What you need in WBC. So WBC and Pinnacle. And also, if you give me the site where she wrote that.
And she just said it was the RRB site. RRB is just, should have 8 years. So that was just the RRB remote. 8 years. No, that's my rating. Okay, all set. We go back on the record. We are going to continue cross of Mr. Rothschild by Ms. Skirris on behalf of the authority staff, please. Good afternoon.
Mr. Rothschild.
Good afternoon.
Harris with Authority staff. Earlier today, you under your cross in the morning, you were referring us to your use of the 2022 Ibbotson book. I'm assuming you mean the stocks, bonds, bills, and inflation book. Is that correct?
That's correct.
And it's no longer called Ibbotson. It's by Kroll, K-R.
That's right. I think it might still have Ibbotson on the title, but it's the company's name is Kroll. Yeah.
Publishes it.
Yeah.
Based on what I heard, it sounds like you have access to that exhibit, which provides like a snapshot of their recommendations for the year. For example, the supply side ERP, you mentioned that.
Yes, they have, I have access to that. Yeah.
Okay, would it be possible that you give us that exhibit? If I recall correctly, it's a summary. It's called Summary of ERP Recommendation.
Yes, I can provide, as I understand, the part in that book where they do their supply side calculations and they explain why you can't just take historical returns as a proxy for the future. That price to earnings ratios have expanded over time. That's not possible to continue forever. So just using the historical data in the way that Ms. Bulkley did isn't valid. So
Is it still the case that they have an exhibit that summarizes each of their recommendations? Like, for example, the 6% that's recommended for the ERP, the general one that is published on their website. Then they used to do, to the best of my knowledge, they used to do arithmetic mean, geometric mean, supply side, arithmetic, geometric, supply side.
I don't know if they still have a summary of all of that. I know that when I was looking at it recently, they did have parts where they summarized a lot of different summaries of historical analysis. And I know that there was a part that had the supply side that talked about the arithmetic mean and geometric mean. I just don't know if there's one place where they summarize all of that.
They don't. There used to be, if you recall, there used to be one page in the back of the book that had all these recommended ERPs.
I can certainly check. I don't know offhand.
I would want you to check that, that's for sure. And if you could just give us the 2022 supply side ERP from Kroll. Do you have that offhand or?
It would take me a few minutes. I don't have it right in front of me. I'd have to go online to there.
Since you're going to investigate that with the others, maybe we could just assign a late file to that and say Kroll 2022 ERPs recommendations with emphasis on the supply side recommendations.
Okay, so it's late file exhibit 143.
Earlier today, there was some exchange between myself and the company and Dr. Woolridge regarding the company's recommendation to include this eCAPM approach. Do you recall that?
Yes.
Have you had the opportunity to review or consider the company's suggestion for inclusion and also Dr. Woolridge's explanation for exclusion of that eCAPM?
Yes, I have read that, and I'm generally familiar with that argument that's been made for years. So, yeah.
Okay, and in this testimony, you didn't provide an eCAPM.
No.
Would you err on the side of Dr. Woolridge to exclude, or?
Yes, I would recommend to exclude. I mean, one important reason the eCAPM is empirical CAPM, and that was based on a study that looked at historical data and historical relationships. And I think one of the concerns of that model and it's not, I'm not the only one, is that it could be like a, anytime you look at data, you're going to find certain patterns, and it seems like that's been going away. So it's kind of a, is that a solid analysis? You're saying I've seen this pattern in the past, but there's no way to, it's not a valid conclusion. Just in summary, it's just looking and found a pattern over a certain period of time. That doesn't mean there's any cause and effect there, or that it could be sustained in the future. So I don't recommend considering the eCAPM.
Okay, a little follow-up here based on my review of that. If I recall correctly, and Dr. Woolridge discussed the book of Professor Morin, the study was done in 1984. Is that correct? If you remember?
That makes sense. I remember seeing it was quite old, yeah.
As far as I know, they've never really done any update or any backtrack to verify that the track that it recommends is valid.
It's a great question. I've seen some conclusions that those patterns were not seen after that time period in 1985. I think that's a great question and should be investigated further, but I don't have a specific study in mind, but I have seen that pattern has gone away.
Yeah, and it's 40 years now, so we're basically still trying to incorporate something that happened 40 years ago.
It's time for an update, at least, yeah.
Okay, thank you. If you reference your EOE response to RRU 407, and if staff here would help me by opening up under Rothschild.
Thank you.
Where I have the staff exhibit. Nope, not that. Here's another one. Yes, there we go. We're going to pull something up that I kind of pulled together. From your response to RRU 407, looking at the ratio there for the 46.0704% common equity that you have recommended, looking at the credit ratio and the benchmark associated with it, it did not appear to me that that in of itself would yield a downgrade.
Just make sure. This is from EOE's response to 407?
Yeah.
Oh, I see. When in our response, we didn't have this exact table. You made this table, right? Okay. I see. Okay. Yeah, so that was when I made the calculation and determined it was unlikely to lead to a downgrade based on the metrics that you asked me or asked EOE to look at.
Okay. And same thing with the OCC recommended equity portion of the 50%. Is that correct?
That's right.
If we move on to RRU 407 Part B.
Yes.
Could you clarify how that 16 basis points reduction to the ROE was calculated based upon the assumption the authority adopt the OCC recommendation of 50/50 versus your recommendation of the 46.04?
Yes, that was based on a study that I did, and that was done a while ago now. It's not really possible to repeat this study exactly because there just aren't as the proxy group of companies wouldn't be enough. It's more challenging. But basically, it was a study to compare the DCF cost of equity result to changes in capital structure. And it ran a regression analysis, and it indicated how much of a change, how much the different capital structures impact the cost of equity. And based on that study, I determined that going from 46.04 to 50% common equity ratio would mean that the cost of equity should, or an authorized ROE should be decreased by 0.16 or 16 basis points.
So approximately 4 basis points per point.
Yes.
To the best of your knowledge, do other witnesses recommend such a reduction or adjustment in the event their capitalization mix is not accepted?
I've seen that discussed in many different contexts where people, I think it's generally accepted that change in the capital structure would impact financial risk and would therefore impact the cost of equity. So I don't think I'm really I'm not unique on that. It is done in many contexts. I don't generally see witnesses say I have one authorized ROE if my capital structure is recommended and a different one if another capital structure is recommended. But I do think in general people accept that a higher common equity ratio would lead to lower financial risk.
Okay. This is a little bit of recap here. Earlier today, there was some discussion about incorporating short-term debt component into the rate-making capital structure. Do you recall that?
Yes.
I asked both the company and Dr. Woolridge. Subject to check in your presentation here, you have not recommended incorporating a short-term debt component carved out from the debt, long-term debt, as, for example, a separate class of capital for rate-making purposes. Is that correct?
Yes.
And in other dockets, you have done so. I reviewed your pre-filed testimony and the Aquarian one, 220701 or whatever that is. Can you discuss here further if you would based on testimony thus far, would you change your recommendation in this case to include the short term as a separate class of capital? And if so, why?
Well, I agree with Dr. Woolridge in general that it's appropriate to consider, and I agree it's important to, well, in general to consider. That's why in some cases I do recommend including short-term debt. In this case, I didn't for a couple of reasons. One, I know that it's a general policy of Pure to not do that, but I certainly would have recommended short-term debt if I felt it was important to get to a fair rate of return for consumers. In this case, we have an inverted yield curve, so we have cost of short-term debt that is similar, if not a little even higher than cost of long-term debt. So in principle, it should be considered. In this case, it wouldn't really impact consumers' rates at all. I think I had heard a quote, I think it was Mr. Ortega said yesterday, I think their cost of short-term debt was around 4.7%. I guess higher than their cost of long-term debt now.
Also, Dr. Woolridge explained that his analysis also tracks how short-term debt is used with regards to the rate base. Do you consider that as well when you were making your analysis?
Yes, I do. Generally, I look at it from the perspective of the FERC methodology, which is to look at the construction work in progress earning the AFUDC, and if that is equal to or greater than the amount of short-term debt, then I will not recommend having amount of short-term debt. So I do that kind of analysis generally. Here, I didn't go as deeply as normal because again, the inverted yield curve was a major factor where I didn't have to always pick the battles a little bit, and I decided that it wouldn't protect consumers in this case because of the high cost of short-term debt.
Okay, thank you. Peer group. We did have some exchange with both the company and OCC on the selection of peer group. Referencing your SIR rebuttal, pages 10 and 11, there's some criticism regarding your LEAPS proxy group. Is it correct that to infer that the LEAPS proxy group is not a traditional cost of capital proxy group in the sense that you're trying to mimic the risk of the target company whose cost of equity is being measured?
I'm not sure I understand your question.
The question is it correct interpretation that the companies selected for that LEAPS proxy group are not a traditional cost of capital proxy group in the sense that we would select companies to try to mimic the risk profile of the target company?
I think that this is a valuable analysis. I wouldn't recommend using this group to calculate the cost of equity in DCF and CAPM. I think it would probably be too high. It has some companies in there have a low investment grade credit rating, so it would probably be a result that would be a little bit too high. But I think it's important to recognize that we can't do this kind of analysis for all the companies because they don't have LEAPs. So I think the general trend is helpful in understanding what I think you would see if all of the electric companies in my group had these LEAPs. And it's important also, I point out in my rebuttal testimony, that when you look at the companies that are in my proxy group, there are 4 of them that have LEAPs. You see a very similar pattern to what we're seeing with this LEAPs group. You also see what the company, so that's just important to recognize, a good indication that this is showing us a pattern that is relevant to Ms. Bulkley's proxy group, my proxy group, and electric utility companies in general.
I'm not sure if you grasp what I'm trying to ask, but my understanding is that LEAPS group that you present is basically a bunch of utilities that have these LEAP traded options. Is that correct?
That's right.
And not all the companies followed by value line are going to have LEAPS traded options, so they won't make it into your group, right?
That's right. Only 12 of the 36 make it.
So is it correct that the risk tolerance developed in that group of LEAPS company, or the risk profile, is not going to necessarily mimic the risk profile of UI?
That's right. I think it would most likely be a little higher. Yeah.
So it's higher.
Yeah.
So in other words, if it's higher, then the return generated from your LEAPS group is going to be higher than necessary for UI?
I would, yes. I wouldn't recommend using that. Yeah.
Earlier today, we had some exchange on the companies that were presented by the company's witness and OCC's witness as the proxy companies for all intents and purposes, the authority's ultimate allowed proxy group. Subject to check in RRU 408, you found that Dr. Woolridge's group to be superior. Is that still the case based on what you heard with this morning's exchange?
You're referring to response to RRU 408.
Yes. You used the term superior, and I think you identified superior being more companies.
Yes, I would agree with Dr. Woolridge. It can be helpful to use as many companies as possible.
Okay. So subject to check, part of this, if you recall the exchange between both parties, the crux that allowed Dr. Woolridge to add some of these extra companies into his proxy group was that he was using 50% as the threshold of regulated electric revenues.
Yes.
So he got more companies in. Well, the company's threshold was 70% regulated electric revenues, and the revenues being utility operating income. I mean, that's a pretty broad range. In other practices, when you do more of a traditional cost to capital approach where you're trying to get a company, Proxy Group, that is close to the target company? Do you have a threshold parameter that you utilize? If so, what is that?
I've generally, I used to, maybe it was a number of years ago, I used to spend considerable time debating the appropriate proxy group. I found over and over again that the difference was very small, maybe sometimes as much as just 3 basis points difference. So when we're debating whether you add a few companies, especially if you had a large electric group, it made almost no difference. And I suspect to be similar in this case. So that's why I generally, unless there's a very strong reason, I generally try to go with the company witnesses proposed proxy group, so that at least have one less thing to consider. But I didn't do that here to compare the difference. But I feel that both, although I as I mentioned, I think Woolridge's group was helpful because I had more companies, a larger sample size. But I didn't find there were so many other issues that were important, except leaving the proxy group aside.
Okay. Well, one of the companies Dr. Woolridge recommended deleting from the group of that the company presents as Otter Tail. There's an issue there with plastics industry. Would your recommendation be to remove it from the ultimate proxy group because of the revenue issue?
I would have to look in more depth to say.
Let's move on to your group of LEAPS companies. And I'm going to focus in on there's Southern, CenterPoint Energy, Exelon, First Energy, PPL, and Sempra. Do we have in the record the credit ratings of these companies? If not, maybe I'd like to see their credit ratings.
I can certainly provide that. I know that at least one has is below investment grade. Yeah.
So could we take a late file on that, please, which would be credit ratings of the LEAPS companies, Southern, CenterPoint Energy, Exelon, First Energy, PPL, and Sempra.
Okay, that's late file exhibit 144.
I apologize. Can we just?
Could you repeat the companies in the that you were looking for? Thank you,
Sure.
Ms. Lewis.
Yeah, I'll give you the codes too. Southern Co., which is ticker of SO, CenterPoint Energy, CNP, Exelon, EXC, First Energy, FE, PPL Corp, PPL, and Sempra, SEMPRA, and the code is SRE.
Thank you.
No problem. Now, regarding these companies, you indicated some of them don't have value line. They're not followed by value line.
I believe they all are. I started with the 36 companies covered by value line and narrowed it down to 12.
Okay. So it's value line companies with LEAPS.
Yes.
In terms of growth rates for these companies, are growth rates from Yahoo Finance and Zacks in the record for your LEAPS companies, or did you not perform the DCF analysis on those particulars?
I don't believe that's in the record, those growth rates, but I'm actually not sure. I did not rely on those results for my recommendation, but I make a lot of different calculations. So I'm not sure if those were included in the work papers or not.
Okay. Could we maybe have you investigate this, and if not, give us the growth rates of those particulars of Yahoo and Zacks?
Yes, okay.
So I guess we could call it pure data for LEAPS companies. 155.
I'm sorry, it's just the beta for the LEAPS.
Sorry, no, the growth rate.
Okay, well then 144 can be the credit ratings and the growth rates
Okay.
for the LEAPS companies, please.
Yeah, the betas, if they have value lines, the betas would be on there. And you confirm that.
Just for clarification, that will be so that will be part of LFE 144. And so in addition to the credit ratings, we're also looking for the growth rates.
Yes, please.
And it's only for those same six companies?
Yeah.
Okay.
Thank you.
It'd be the Yahoo and the Zax. If you turn now to your response to RRU 410 Part B.
Yes.
Specifically for Edison Electric, EIX, and Entergy, both having capitalization mixes under the 40%. Given EIX and Entergy have substantially more debt than the other peer companies, you would agree that they would be riskier, is that correct?
At least in terms of the financial risk, yes.
Under that presumption, would it be reasonable for those companies that have high debt to be excluded from the proxy group?
That's a good question. I think in general, I look at when you look at a relatively large group and you look at the average capital structure, which is 46.04%, the average common equity ratio for that group, that is impacted by those numbers. So in terms of a large group, I think it certainly is impacting my result. Removing them would be certainly a reasonable test to see how it impacted. But yeah.
So you'd suggest running that type of analysis to see with or without how they skew possibly the ultimate return.
It's a reasonable test. I don't think it would make a huge difference just because you're talking about a large group and it's being averaged in, but it certainly would be a reasonable test. Yeah.
Okay, let's move on to RRU 411. Okay. Under the hypothetical that sustainable growth rate as calculated by the B times R plus SV is included in staff analysis, what weight would you recommend giving it? Would you give it, under the hypothetical, let's say I have 5 growth rates I'm looking at, and I got Saks, I got Value Line, I got the Yahoo, and then, as you know, you can compute a sustainable growth rate off the Value Line projection there, right? As we discussed earlier with Dr. Woolridge, would you just treat that sustainable growth rate as just another growth rate in the pie, or would you give it more weight? How would you analyze that?
Yeah, I would give it more weight just because just taking an earnings per share growth rate and just as a proxy for long-term growth is problematic, just because for simple mathematical reasons. It's just, as a quick analogy, it's like saying how much money am I going to have in the future and only counting how much money you're putting in the bank and saying, oh, how much I spend doesn't matter. I think to what the sustainable growth rate does is consider that. It says how much money is coming in, and how much money am I spending. So it's accounting for that. So I think it should be given much greater weight because it considers
Than the
that.
analyst growth rates?
Yeah, I mean, you could consider the analyst growth rate for sure, but you should consider that mathematical relationship between how much you're putting into your bank account, how much of that retained earnings is the company keeping, and how much are they spending or giving out to investors.
Okay, so you would definitely support the first purest past practice is to include a sustainable growth rate as part of the pool. You would definitely support that going forward in this case.
Absolutely.
Let's move on. Oh, this is your rebuttal. It's page 32, around lines 18 to 20. And I just wanted to clarify what you're trying to drive at here.
Where it says, in other words, this 10.10% is an accounting figure, starting there?
Yeah, around 18 to 20. And correct me if I'm wrong, but it appears to me essentially you're trying to drive a distinction between what's an accounting return that the company can possibly earn on its assets, while the investor return is what an investor needs to invest in a company.
Yes.
Okay. And those are two different things. Can you maybe try to drive a wedge between those two, because they appear to have combined or treated basically the same?
Yeah, that's why I was asking Ms. Bulkley earlier about that confusion. I was surprised that she didn't have any frustrations with that. I found doing this for many years that people get very often frustrated or confused by that, because you see ROE referred to as return on equity or authorized ROE or cost of equity, and it all gets jumbled together and it's very hard to see. So I'm glad you're asking this question. The most important point is, if you look at the return on equity, or what investors expect in terms of the return on the book equity, you can't earn that because you can't buy it at book value. You could, or something close to it, if you expected a return on the book equity of 10% and you bought it at book value. The math is you're going to earn about that, but you have to pay about twice book, so you're going to earn significantly less than that. So it's very important to keep that in mind in terms of what is an accounting return and what's a return you're going to actually earn if you go and an investor goes and buys that stock. If you open up TD Ameritrade or whatever, if you use a brokerage firm, you cannot buy those utility stocks at book value. You have to pay a premium, so you're going to be earning less. Yeah.
Thanks. Let's move now to RRU 413. The date of the table is dated October 31st, must be 2022. And the submission response was 2023.
Sorry, which one is it?
RRU 413, please.
413.
The question is, why is there, why is the table so dated? It's like a November, December, 3 months. Was it a function of the data availability?
Oh, that was to be consistent with the data that I used in my direct testimony. That was the only reason.
Okay, great. Thank you. Maybe we can skip back now to RRU 412, where I was asking you about the value line forecasted dividend column F. You ran an analysis and found essentially a 1 basis point difference between that and the approach where an analyst would use half times 1 plus G. Is that correct?
Yes.
So based upon that, the EOE would not have take issue with the authority just utilizing column F, and subject to check, that has been our practice for many years to utilize the value line column F for the forecasted dividend.
Yeah, I wouldn't see any problem with using that.
Okay, thanks. We're moving along. Okay, this is a question on CAPM and the risk-free rate. In your SIR rebuttal, pages 18 and 19, and then would be an RRU 414. What'd you get? Okay. In your analysis of the CAPM, you do use U.S. Treasury bills, short-term bills, as proxy for the risk-free rate. Is that correct?
Yes.
Yeah. That's not typically the approach taken in this cost of capital approach, based upon testimony given that, you know, we're trying to match a long-term asset. Are you familiar with that argument about the
Yes.
long-term asset?
Sure.
Have you considered that, and why do you continue to utilize the spot, the bills rate as a proxy? And I know you do other scenarios.
I think in this case they're identical, if I remember correctly. I think they're both at 4.22. Oh, let me double check. I may be. Yeah, this is rare that they're identical or so close. Usually there is a big difference. So, I mean, obviously it's still worth discussing in principle because I suspect they're going to at some point not be the same again. And so I would agree that there's a trade-off because in one sense we should, many investors are long-term investors looking to the future, and also we have these assets are long-term. I think Ms. Bogby calculated the average life of the assets is over 21 years, I believe. So in that sense, it's good to look at the risk-free rate and then the 20 to 30-year time frame. The problem with that is they're not risk-free. They have a non-zero beta, so that's a bit of a trade-off. So that's why I hope it's helpful to Pierre to see both.
Well, in this case, you said the bills, if you wouldn't mind just giving us the numbers for the record that you have there, 4.22, you said was the US bills, and then the long.
Yeah, if you look at on page 79 of my direct testimony, table 9, the 3-month average of Treasury bills, the 3 months average was 4.22%. The 30-year, the average was 4.22%.
So it's a very anomalous situation.
Yes.
But in practice, you do, in this case, it doesn't matter, is what you're saying. But in practice, you have utilized this approach with incorporation of the bills into your analysis. It just, yes.
Here just happens to not matter. Yes, it mattered a lot when we were back during 2020. For example, we had a very steep yield curve, so it made a big difference. Here it doesn't. Yeah.
Okay, and then if you go to your SIR rebuttal at page 21.
Yes.
This is a question regarding the use of the options implied betas. Are you suggesting that those be a proxy for beta in general?
I think so. I would consider historical betas as well. just to capital markets are always changing, unpredictable. I think it's good to consider from a number of different angles. The wonderful thing about the option implied betas, as we've been discussing, is they adjust in changing market conditions right away. So when it can take like the 5-year historical beta months and months or even longer to adjust, I think it's a valuable result to consider in terms of. I would like to think it's a valuable tool. Yes, it should be included.
That was my next question, is if you would agree that the option implied beta approach is just another means to establish the reasonableness of a beta that's going to be used in a CAPM.
Excuse me, can you repeat that question?
Yeah, would you agree that the option implied data approach is another means to establish the reasonableness of a beta that will be used in the CAPM approach?
Yes, I think so.
And you're also suggesting that it's not the only correct method.
I mean, I think multiple numbers should be considered. And what I would say is, over time, there should be continual testing. I'm frustrated when people say this is a method that's been used for a long time, therefore we should keep using it. I think we should get away from that kind of thing. We need to continuously be testing any kind of method. So I think this is extremely valuable. It's amazing how it showed us really clearly after COVID, when all the betas jumped up, option implied betas came down right away, and all the historical betas followed like a waterfall, which is a really powerful example that investors knew market conditions had changed, and it was reflected in option implied beta. So I think it's an extremely valuable tool. I hope I'm answering your question, but I think any methodology is something that should be considered, always considered in a broader context.
Okay. Well, I think I'm all set with Mr. Rothschild. I do have issue.
All right. Very good. Then if staff has completed their cross for Mr. Rothschild, then we have one party attorney wheel that OCC had reserved cross. Okay, very good.
Good afternoon, Mr. Rothschild.
Good afternoon.
We've met, but I feel weird cross-examining someone without introducing myself. So my name again is Tom Wheel. I'm a staff attorney with the Office of Consumer Counsel. I have a couple of questions that are follow-up from some of the testimony you've already offered today. The first one I want to ask is, during the company's examination of you, they were asking a couple of questions about a publication that seemed like it was noting the value of option implied betas in the context of mergers, acquisitions, IPOs, bankruptcies. Do you recall that line of questioning?
Yes.
It sounded to me like the quote that the company's lawyer was reading was essentially saying that option implied betas can be especially valuable at getting a more immediate measure of the impacts of those kinds of events, because those kinds of events tend to have market impacts.
Yes.
Am I understanding that quote correctly?
That's correct.
Okay, so is it your understanding of that quote that option implied betas, was that quote standing for the supposition that option implied betas are only useful in those contexts?
No, I think they can be useful in measuring change. They can be useful in measuring that something hasn't changed or things are returning to normal. So I think the main point is they give us a snapshot of investors' current expectations.
Thank you. I've read some discussion and heard some of your testimony here today, and actually testimony from others about setting ROEs and market to book ratios above 1. Could you explain in layman's terms the significance of that interplay?
The significance of the relationship between the market price of stock and the book value of stock, and specifically the market to book ratio?
Yeah. Yes.
It's very important because authorized ROEs are applied to rate base, which is usually very, very similar to book value. So the returns that investors are going to actually receive is not the return on book. And what we're doing here is to try to measure investors' return expectations, and their return is the return on the market price. I think no one here would care if you buy a stock. They could say, well, the book value return was really high. It would not impact your retirement savings one bit. It would only be the return on the market price that you purchased.
Thank you. So just to make sure I understand, and this correlates a little bit with what you were just discussing with Ms. Skouras with regard to the difference, I think, between the cost of equity and the return on equity. What I have the same thought that it seems to me that in the context of what we do here, that book value is similar to what we think of as rate base, in that it's the value of the actual assets of the company that are capitalized, right?
The accounting value, yeah.
Yes. And to measure market value, my understanding is you would take the actual value per share and multiply that by the number of shares that have been issued, right?
Yes.
And those two numbers, in my understanding, aren't necessarily correlated at all. Is that an accurate understanding?
I would say necessarily correlated, but they're certainly not necessarily the same. I think the electric are about the market price is about twice the book on average.
Thank you. I saw in your rebuttal testimony on pages 12 and 16, I was looking at these charts 15B and 15C, talking about the term structure of cost of equity. Could you just explain what those charts are showing?
On page 6.
Pages 12 and pages 16, they're charts 15B and 15C.
Yes, on page 12, so chart 15B shows that the investor's expected return on the market price of the equity is downward sloping, which means that over longer periods of time, they're expecting lower returns. Now, in the beginning, over 1 month for the S&P 500, starts about 10%, jumps up to 12%, but then declines over time to the 61 month time frame to be close to 9%. So this can be, may feel somewhat abstract, but it's not so much, because it would be like with we all know there's a term structure of interest rates, and if you go to get a mortgage, for example, for a 5-year ARM or something, you may get one rate, and if for a 30-year you would get a different one. So I think it's quite intuitive that we understand there's a term structure of interest rates, and this is what we're showing here based on the options, is a term structure of the cost of equity, which is downward sloping for the S&P 500. We also show with the orange line that it's downward sloping for the RFC Electric Leaps Group, which is the 12 companies that have traded leaps. But we also see a very similar pattern with the 4 companies that have leaps that are in the RFC Electric Group, so also in Ms. Buckley's group, very similar pattern, downward sloping. That this is important to consider because this isn't usually the case. It's usually upward sloping. So that was why I had run this test, to see we have such high inflation and increasing interest rates. What did that mean for the cost of equity? The first instinct would be, well, it's going up, and investors expect it's going to keep going up. But the options say that that's not true. And it's interesting that since I built this chart, the cost of equity has come down. Investors aren't always right, but this chart did indicate what investors expected and what actually happened.
Sorry, did you have?
I'm done.
And I'm going to retract what I was about to ask. Actually, it's my understanding Ms. Bulkley criticizes your 6-month beta coefficients. Can you explain why you use that 6-month range?
The 6-month beta coefficient is helpful for a number of reasons, or I use it for a number of reasons. One is because it allows me to use the largest possible group of companies. I think almost all, probably all electric companies in the group have options that are around, that go out as far as 6 months, or usually about 7 or 8 months. So that means we can include all of the companies, or just about all of them. And so that's helpful. That's one reason. Also, the papers that we were referring to, it's getting a little bit dated now, going back to 2012, but they had found that time horizon in many different ways to be a good predictor of what future historical betas would be. So we think that's valuable. So those are really the two reasons.
Thank you. I have some kind of along the same lines of your first questions for Ms. Bulkley, in terms of the notion that you feel that in the role you're playing in this rate case, you're sort of playing an educating role. I appreciate that as someone who's trying to understand this stuff. So I have some very basic questions I'm going to go through. My first question is, there's all this discussion about risk, and the CAPM, is my understanding, is a way to kind of measure risk. Can you just start by explaining why there's this focus on risk when we're talking about how to set an ROE in a rate case?
Yes, risk is critical because investors demand a risk, or a premium for risk. We call it a risk premium. Generally speaking, for very safe assets that deserve a lower return, and for a higher risk they deserve a higher return. And that's really where the CAPM is constructed, to measure risk and return directly. And specifically, it's a theory that what investors care about is what's called non-diversifiable risk that you cannot eliminate by buying a lot of stock or building a large portfolio. So that's in the CAPM. That's why it's helpful. And we as indicated by beta, which is the measure of the non-diversifiable risk in the CAPM, utility companies are less risky than the overall market. And so that helps us measure what the cost of equity is for utility companies relative to the overall market. So that's very, risk and return is really what rate of cost of equity is all about. Yeah.
Okay. We have a revenue decoupling mechanism here in Connecticut. Are you familiar with what that means?
Yes.
Are you aware of any other industries where companies are ensured that they'll receive an exact amount of revenue down to the dollar on an annual basis?
No, that's why generally companies that are unregulated are riskier, and that's why it's important to recognize that at least a portion of the companies in our proxy groups have unregulated operations that are riskier. So we should view our results as somewhat conservative because of that very point you're making. Yeah.
Do you know if every regulatory jurisdiction has a revenue decoupling mechanism like we have here in Connecticut? With the same level of guarantee that the revenue requirement issued in a rate case is exactly what the company is going to collect then as reconciled?
I don't know of any others that have that level of guarantee. No.
Okay. So would that make Connecticut and even among utilities, Connecticut-based utilities, even among utilities, it seems to reason that would mean there's even less risk in a jurisdiction that has that kind of mechanism than in a jurisdiction that didn't?
It would certainly be risk reducing, component, yes.
Thank you. This is a question I've been struggling to understand. I'm hoping you can help me with. What exactly are the risks that a company like UI faces at an operational level? Like, what are we talking about is going to happen? What's the risk that's going to go wrong for UI in this environment where there's a guaranteed revenue?
I guess one thing that's important that I generally focus on capital markets and what investors are saying in terms of risk relative to the overall market, and so I really focus on capital markets. And so when these operating risks and when investors do a fundamental analysis and they see all of these different risks or lack of risk, that'll be reflected in the capital market data. So that's why I focus on that as opposed to digging into each possible risk. But it is an important piece with a regulated utility is given a franchise and is a regulated monopoly, and they have an obligation to serve, but they also are protected from competition. So regulation is there to serve as a substitute.
Yeah. So I mean, just to clarify my understanding, if I incur the risk of investing in a private company, an unregulated company, Apple Computer, for instance, I'm incurring the risk, the possibility that Apple Computer might fail, might not derive enough revenue or attract enough capital, be able to get debt sufficient to meet its costs, and might collapse, right? That's part of the risk I'm buying.
Absolutely, yeah.
Okay. And as we just talked about, having something like a government entity telling you that you are guaranteed to be able to cover your revenue needs, and guaranteed the outlook of knowing exactly what your revenue is going to be, whether you are happy with that number or not. Does that have an impact, in your opinion, on whether a company is likely to fail?
Absolutely, yeah. Risk reducing.
Thank you. Are you familiar with any kind of analysis that compares average returns on equity between different industries?
You're talking about the accounting return again?
Yeah.
I've done that myself, and look, they're all over the place. You see from 4 or 5% to 80% or higher. Yeah.
Okay. Have you looked at a database like that that's maintained by NYU that tracks returns on equity by sector?
I think I know the Professor Damodaran you're referring to. I've certainly reviewed his information. Yeah.
Okay. So based on what we just talked about, that there aren't, I think what you testify, and correct me if I'm wrong, is that you can't think of another industry that has the kind of revenue, the degree of revenue expectation or certainty that the utility industry does. Is that correct?
I
That you
can't think of one. No.
Okay. So given that, and given what we just talked about between the connection between ROE and risk, I would expect that analysis would show that utilities have the absolute lowest ROEs across all industries. Is that what that kind of analysis shows?
Well, I would say some of the lowest cost of equity, but not necessarily the lowest return on equity, because you can have companies that are doing poorly. They could have a negative return or very low. So it's not necessarily the lowest return on equity from that perspective, but I think one of the lowest cost of equity. So what more of expectational. Yeah.
Okay. But if you look at that analysis, isn't it the case that utilities, which is an industry tracked in that analysis, is actually somewhere around 129th place out of 384 industries that are tracked? In terms, if you ordered them by escalating ROEs?
On the Damodarans, let's say?
Yeah.
I'd have to check, but it seems similar to what I've seen in the past. Yeah.
Okay. And would it surprise you, as it did surprise me, to see that industries like auto parts, oil and gas distribution, and consumer electronics have significantly lower ROEs on that chart than the utility industry?
Would it surprise me that they have lower ROEs?
Yes.
I'd have to see. So I understand like I said, the ROEs can be an accounting figure, so you have to really look closely. So I'm not sure how surprising that'd be unless I looked.
Okay, thank you. Page 22 of your testimony, you have a quotation from a Supreme Court decision called Bluefield Waterworks versus Public Service Commission of West Virginia. And the quote says that, well, it's kind of half of a quote, but you say that we must, quote, allow these utilities to raise the money necessary for the proper discharge of its public duties. Is that accurate?
Yes.
So raising the money necessary for the public discharge of its, sort of the proper discharge of its public duties, the way a utility does that is by attracting capital, right?
Yes.
And by attracting capital, we're talking about selling stock?
Stock and issuing debt.
Thank you. So the idea, is it your understanding that the idea of the guidance of that Supreme Court decision, and more generally what we're trying to do here, is set an ROE that allows the company to attract the capital it needs to be able to provide service?
Yes, without overcharging. So not too much. Enough, but not too much. Yes.
Yeah, maybe like sufficient, but not more than sufficient.
Yeah, if you argue an authorized ROE of 30%, of course they could raise money, but that would be massively overcharging consumers. Yeah, so
okay,
enough.
So that's why it's relevant to consider the attractiveness of stock, right? That's why part of what we're doing in this analysis is considering whether investors are going to be attracted to purchase the stocks of the parent companies of these operating entities. Is that accurate?
Yes, I'm just pausing for a second here. Yes, that's true. There's more to it, but yes.
Okay. So, in your opinion, what attracts investors to purchase a particular stock?
I think going back to what we talked about risk and return before, if investors are doing a trade-off between risk and return, and they feel that they can earn a return that's consistent with the level of risk, then that they would determine to be attractive. Yeah.
Okay, and the return that you earn when you're buying stock is what that means at its most basic level for people like me to understand is you're buying the stock for a price and you're hoping to eventually be able to sell it for a higher price, right?
Yes, exactly. That would be the capital gains. Yeah.
Okay. And in your conversation with the company's lawyer earlier, there was a discussion about people investing in options, and you acknowledged the word you used was that people can invest in options in a kind of gambling behavior. In your opinion, do investors ever invest in equity in stocks for similar reasons, for similar kind of gambling behavior?
Yeah, absolutely. People can invest for all kinds of reasons, also including stock. And one way you can invest in stock in a way that's gambling would be to do leverage, meaning just borrow money to buy stocks. That's another way of speculating that way. The reason why options can be attractive for lottery tickets is because in essence it allows you to have leverage. So, but you can do the same thing with equity.
Yeah. Okay. And are there elements other than a company's earnings that impact the attractiveness of its stock?
Yeah, certainly earnings is one important factor, but there could be many, including investors' expectations regarding what other investors are doing. Yeah, there can be many factors. Yeah.
Okay. And United Illuminating, the operating entity that we're regulating here, they're not publicly traded, right?
No, they're not.
So how do they attract capital?
They attract as Mr. Ortega said, I believe yesterday, if UI run into trouble being able to raise short-term debt, that Avangrid could be able to provide the equity infusion.
Yeah, so it's kind of like at its simplest level, it's kind of the same thing as a publicly traded company, just that a publicly traded company has millions of owners and UI has one owner. Is that accurate?
Yes, and I guess you could say those millions of owners do own a UI through in that relationship. Yeah.
Yeah. So does it make sense in an analysis for an appropriate ROE in this case to include some consideration of Avangrid stock performance and prospective performance? Avangrid being the parent company of UI?
It could, but we run into issues. It just comes down to the idea of what's the most appropriate proxy group. And you have to consider is that a better measure for UI or not? And you'd have to consider that because although it's their parent, they have, of course, unregulated operations as well. So you'd have to consider that.
Yeah, that was going to be my next question is, are there elements other than UI's allowed return on equity that impact the market performance of Avangrid stocks?
Yes.
Okay. And would that be similar for the other companies in your proxy group or any of the other proxy groups advanced in this case that there are considerations other than a single operating company's allowed return on equity that influence the performance of the stocks in those proxy groups?
Absolutely.
Thank you. Have you ever done a comparison between market performance and ROE to see if there's a correlation between return on equity, measured accounting return on equity, and the market performance of a company's stock?
So the authorized ROEs or the accounting, like historical?
Either one.
No, I haven't done that.
Okay. In your opinion, does a lower authorized ROE guarantee a reduction in a parent company's ability to attract capital from its investors?
No, not at all. It's a common argument I hear to say, well, one company has an authorized ROE of 9%, another one has 8%. Investors would never provide money to the one that has an authorized ROE of 8%. It's just not true at all. I mean, because you're not also considering, again, like we said, the market to book ratio and what kind of returns investors are going to actually be earning. So of course, I wouldn't recommend an authorized ROE that's below the real market-based cost of equity, because that would not be good in the best interest of consumers at all. But if it's lower in a relative sense to others, but still equal to or greater than their market-based cost of equity, they should have no trouble raising capital.
Thank you. That concludes the OCC's cross of this panel. Thank you.
Thank you, Attorney Wheel. Attorney Wright?
No questions.
Thank you, sir.
No question.
I have no questions either. Thank you.
Thank you.
Do you need a moment to consider redirect?
We don't have any redirect, Madam Chairman.
Okay, very good. Then Mr. Rothschild, thank you. You are excused.
Thank you.
If the company's lawyer, if a representative from the company, OCC, EOE can stay. Attorney Wright, I want to make sure we're all on the same page about next steps, because I think we have reached the end of our agenda here. So just any mic will do. Okay, Attorney Venora, I first need to circle back on something, please. I know you probably thought you got away with the very last late file, but in reviewing my notes back on the read-in from UU, I'm so sorry. I was reviewing the notes back on the read-in that Ms. Bulkley provided on UU, and I don't think we quite captured what we were hoping for. So if the company will indulge me, it would just be late file exhibit 145, which will be the final late file here. And there was an interrogatory response that she referenced in her response. So I think the first part of the question is if you could just clarify what the interrogatory that was being referenced. I don't believe she gave a number. So if you could clarify the interrogatory response. And then also the information she provided was what we were looking for, but it missed providing the percentage of electric revenues for the WEC Energy and Pinnacle. So I think she touched on 4 of the companies we were hoping for, and it was just the same information that she provided, but for WEC Energy as well as Pinnacle. I apologize for not capturing that.
No worries. We'll include that that'll be late file 145.
Very good. Thank you. And then based on that, I do not show any outstanding read-in requests. That means we have 145 late file exhibits. I believe there's 4 so for OCC, maybe 2 for EOE. Of course, I closed my computer, but the Lotus will show. I think we have the prompts entered through Tuesday of this week, and tomorrow we will upload the remaining prompts from yesterday and today. Lotus has been updated to show the rolling deadlines for those late file exhibits. The only remaining administrative matter I have at this time is to, of course, recognize that tomorrow's hearing will be canceled. And then secondly, to note that we have the late filed exhibit hearings scheduled for Tuesday, Wednesday, and Thursday of March 21st, 22nd, and 23rd, starting at 10, 11, and 10. I will preemptively ask people to consider holding their calendar starting at 9 on that Tuesday and Thursday. Ms. Lupley will, at a later date, solicit cross estimates from parties for late file exhibits. Thank you. Thank you. And I would just ask the attorneys and for the parties and interveners here and listening at home, if you could please, please, please do your best to provide reliable cross estimates. I'm a little anxious about covering 145 exhibits in 3 days. We don't have a ton of other options available to us. So that's why I'm asking you to hold starting at 9 on those 2 days. And it's going to be imperative that we see those cross estimates so we can assess what our other options are. So when you see the email from Ms. Lupoli, if you could take that under strict consideration, please. Recognizing that you have, of course, the right to reserve the right, but I'd ask that you seriously consider giving us your best estimate, please. Before we adjourn this portion of our proceeding, are there any administrative matters from any parties or interveners present? All right, well, I want to thank everybody for your patience and contributions to the proceeding thus far. Still have a lot of work ahead of us in this proceeding, but I want to thank everybody for their participation, and to all of our witnesses and stakeholders. Thank you, and we will see you in a couple weeks. We are adjourned.
Thank you.
Thanks, Dan. Do you want to know?
Yeah, the beard's lazy.
Bye, guys.
Bye.
Tom, good to see you. Take care. Yeah, good to see you. I said the one for that. Yeah. I didn't get any.
Yeah.